24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy, Tom.
Ritika, thanks so much. Let's look at the data right now. We're really focusing on the bond space, as they say this morning. Yields come in and continue a persistent yield move, a price up, yield lower off the Powell press conference. Two-year yield 1.230%. I would note inflation adjusted anything grinds ever lower in Europe. The gilt market in the United Kingdom, the 10-year U.S. had a negative 0.98 at one point. That is extraordinary to see. Guy?
Let's take a look at what's happening here in Europe. Tom, stocks are lower. It is a huge earnings day for European companies. I've listed a couple at the bottom just to give you the idea of the spread. But the stock 600 in aggregate down by 1.26%. Euro dollar just showing a little bit of signs of weakness today, or maybe fatigue after the rally that was seen up into the kind of 117, 118 area. Basically, I would argue that Powell yesterday gave the green light to further dollar weakness, but ironically, that is not what we are seeing this morning. Airbus was up a little bit more earlier, just beginning to fade an earlier rally, but nevertheless outperforming the market. But Lloyd's, again, another UK bank. It was Barclays yesterday, Tom, painting a fairly bleak picture ahead when it comes to the UK economy.
Well, some of those bleak pictures ahead are part of the earnings makeup today. We have a terrific hour for you here on Surveillance. Ken Rogoff will stop by. Jeffrey Curry of Goldman Sachs on gold. But right now, to start strong, Howard Ward joins, I should say, from Gabelli, with decades of experience of having courage to be in the market. Howard, good morning. How do you stay in the market?
Well, Tom, where else are you going to go? Good morning to you. Bonds are the lowest interest rates in history. So, you know, the fixed income route doesn't really work unless you're just looking for a place to hide temporarily. So really, stocks are the only game in town, and we can argue about what the multiple should be, but with 0% interest rates, essentially, it's a big number. So should the market be selling at 20 times forward expected earnings of $164 next year? Yes. What's the risk? The risk is the high level of earnings uncertainty. The $164 earnings number could easily be 140, and the multiple instead of 20 could easily be 18, and then we would be talking the market down about 20% from here.
If you identify Howard Ward, a growth company, a large cap growth company, and they're out at a new multiple, a 28 or a 30 multiple, do you walk through the exercise of saying, okay, I own it now, I'm going to be comfortable own it because I'm not looking out 1 year or 2 year, I'm looking out 3 years or 5 years?
So, Tom, you're familiar with the rule of 72 that tells you how long it takes a company's earnings to double. If you divide, so if a company's growing at 10%, it's going to double its earnings in 7.2 years. Well, we have a lot of companies in the tech land right now, not just tech land, but primarily in tech land, where the earnings are growing at 20%, 30%. If you're growing your earnings at 30%, you're going to double your earnings in just over 2 years, and you're going to be cutting your PE on those today's PE essentially in half over a period of 2 years. And so you can see how these companies that are growing very rapidly can very quickly grow into their multiples. And a 28 to 30 multiple today, again, in a world of record low interest rates, is not what it was when interest rates were even 3% coming out of the Great Recession of 08-09. We're now talking a 10-year Treasury at 60 basis points. And I can't overstate the difference between the earnings yield on stocks today, which is about 5% using next year's estimates, so the forward earnings yield, about 5%, and a 60 basis point 10-year Treasury, the difference between the earnings yield and the Treasury yield is historic. And, you know, the Fed has this thing called the Fed model. The Fed model says bonds and stocks are in equilibrium when the 10-year Treasury equals the forward earnings yield. Well, that means that if the 10-year Treasury was yielding 5% today, stocks would still be fairly valued, to take that to the extreme. And when you look at the dividend yield on stocks, which is about 2%, that's 3 times what you're getting in the 10-year Treasury. And this also is unprecedented. We had in 2008 a very brief period of time when the dividend yield exceeded stocks. And exceeded the bond yields. And prior to that, it hadn't happened since 1957. And now we have a situation where the dividend yield is a multiple of the bond yield.
Howard, good morning. It's Guy. With bonds where they are, I can justify any multiple, can't I? I can extrapolate to infinity. Isn't that the problem of trying to price this market?
Yes, it is definitely a market that is going to lend itself to speculation. I mean, that's what happens when you have a zero interest rate Fed policy and the Fed is saying you're going to stay there for a couple of years. You are asking for a bubble, and you're probably going to get one. And obviously, there are parts of the market today where you could say they're bubble-esque.
Howard Ward with us with Gabelli. We're going to continue with him. I want to talk to him about Apple. Of course, they're out with earnings today, and Mr. Ward has been opinionated about Apple to the moon here. He's
New order place to buy euro at 117.51.9. So I placed an order to buy euro at 117.51.9.
-30. This is Bloomberg. Howard Ward with us with Gabelli. We're going to continue with him. I want to talk to him about Apple. Of course, they're out with earnings today. Mr. Ward has
New order place to buy euro at 117.51.9. So I placed an order to buy euro at 117.51.9.
This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you into some places.
We're clearly going through some very unusual times and enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with BlackRock.
Sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Surveillance. Guy Johnson in London in for Francine Lacroix. Francine reporting on Credit Suisse in Zurich. I'm Tom Keeney in New York. We continue with Howard Ward of Gabelli. Howard, we talk of Apple from time to time. Each of these companies is different. What is the distinction you see in Apple Computer in 2021?
I have to remove the order. It moved too fast. So the order to buy euro removed.
$6 trillion market cap. As you know, reporting tonight, revenues will be about $55 billion, earnings of $2.10 or so. Earnings for this fiscal year will be up, along with revenues, not a lot. Earnings maybe 5%, 6%. Revenues around 2%, but growing your business during a pandemic is a good thing, which results, I think, in stocks being re-rated higher than those companies that are suffering during the pandemic. So with the case of Apple, Apple owns the high-end smartphone market. They own it. And that's about a 40%, Apple has about a 40% smartphone share in the U.S. And with their ecosystem, they have developed an incredible brand loyalty with about a 90% rate of people continuing to own Apple iPhones when they are ready to get a new one. You're going to have a massive upgrade cycle when the 5G phone comes out in September or October. As many as a third of all current iPhone owners are going to are planning to upgrade, according to surveys that we've seen. So Apple's going to have a nice pop in earnings in the next fiscal year, about 20%. And so you have a little bit of a cyclical kicker with the stock for the next couple of fiscal years as we go into this new product cycle. The real thing that's been happening at Apple and what has powered all of the increase in the shares this year really is the re-rating of that multiple. You know, we're up to 25 times next fiscal year's earnings. That's probably appropriate in this market. The re-rating is happening because the services revenue is continuing to grow. Services, when they report today, are going to be about 26% of revenues. That's up from 17% or so a couple of years ago. And so you're getting a higher and higher multiple on a growing earnings base.
Howard, how much more tax will this company pay if we get a Democratic sweep in November?
Well, I think not just Apple, I think you're looking at a substantial increase in the corporate tax rate to 28% or so. I'm not sure what the actual differences would be in the effective tax rates, but there will definitely be an increase, and that's important because, again, that goes back to the uncertainty regarding next year's earnings for the market. It's not just about COVID and the vaccine, it's about tax policy and the election. And so, you know, profits are essential. Jobs derive from profits. Dividends derive from profits. And so, as investors and as workers, you need profits to support jobs. And profits are under pressure, obviously, this year. They're going to rebound in the second half of the year. But we're not going to get back to the level of earnings that was expected for this year for 2 to 3 years. And so the real issue for this economy is how quickly can the unemployment rate go down? It's over 11%. It's over 11% now.
Hey, leading age, you're on the wrong place. We don't do research. You have to read description. We're not academy. You have to discuss it with schools or academy. We're traders. We trade live our own money, so we don't have time to do research and give you research. It will cost thousands of pounds. So basically, we won't do this. Sorry, mate.
Technology and monopoly with Michael Wolf. We do that next. This is Bloomberg. Futures deteriorate negative 29.
Hey, leading age, you're on the wrong place. We don't do research. You have to read description. We're not academy. You have to discuss it with schools or academy. We're traders. We trade live our own money, so we don't have time to do research and give you research. It will cost thousands of pounds. So basically, we won't do this. Sorry, mate.
Came pretty quickly over the last 4 months. Once the lockdown happened, we decided we no longer wanted to be in an apartment building and we wanted to have a little bit more room for our family.
I think the pandemic really caused the glue to hold the commitment we had to Manhattan to fall away, because
restaurants, bars, New York City nightlife, Yankee Stadium, everything about the city. We still love the city, but with the way things are going right now, like I said, I think it's a good move for us and our family.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juicy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
Our services are about connection, and our business model is advertising, and we face intense competition in both.
We have fierce competition at the developer side and the customer side, which is essentially, it's so competitive, I would describe it as a street fight for market share in the smartphone business.
In the few categories which are commercial in nature, we see vigorous competition, be it travel, be it real estate.
We don't have a dominant share in any market or in any product category where we do business.
History shows that if we don't keep innovating, someone will replace every company here today.
And really interesting, I thought our Matthew Miller in Berlin today was particularly prescient on this a few hours ago, talking about the monopoly or non-monopolistic characteristics of some of these companies, including Apple. Right now, my conversation of the week on technology, Michael Wolff, you may not know the name, he came out of McKinsey years ago, and he did a few things like with Sotheby's, he did a few things like with Yahoo, and he's always been able to develop that linkage of strategic technology over to the tactical execution of said strategy. We're thrilled that Michael Wolff could join us from Activate this morning. Michael, are these companies monopolies like Ida Tarbell and of Standard Oil of years ago?
What's fascinating is they're not, each one of them is not a monopoly, but they certainly in each case dominate their part of their industries. Where in yesterday's hearings, what was clear though, and what you have to agree with is they are going to face a lot of competition. They have Chinese companies, in the case of Apple, Huawei, Samsung from Korea. Each of them is going to face competition, but they're in a great position, and they do have a massive amount of control.
The distinction here, Michael, to me, is with Standard Oil, we broke the companies up into like companies. The critics want to break up the divisions of these companies. They want to break up the parts of these companies. Is that a successful path?
There isn't much to separate off from these companies. I mean, maybe you could separate off the core Amazon retail business from the Amazon Web Services, or in the case of Facebook, you could probably easily separate off WhatsApp, which is their messaging service that they purchased for $20 billion from the rest of the company. And Apple, I don't see what you would hive off. And so in each case, it's unlikely. There isn't some easy breakup here. This is not like the breakup of the Bell system.
If we can't break them up, we're going to have to find another way of dealing with them. That certainly seemed to be the message yesterday coming from some of the congressmen. Michael, what is the biggest threat to these businesses right now? If we can't regulate them and we can't tax them, if we can't break them up, are we going to tax them more?
I think that the biggest risk here is regulation that will hamper their ability to do some of the things that they've done that give them outsized economics. So expect that the Justice Department will try to do something about Apple's App Store and try to make sure. Right now we're having a problem where Apple is trying to take more of a share of any transaction that happens through an app. Apple believes that it should get its 30% its tax itself. And so in each case, you have to expect that there's going to be regulation or there's going to be attempts to hold them back.
Are these companies worth as much if we get a virus? How much has structurally changed in their favor? If we get a vaccine,
Right, in each of them, it's different for each of them. In the case of Amazon, we see e-commerce sales way up, and e-commerce sales are, and they're set to dominate that business. I mean, it's not as if what we do see is that other companies like Target and Walmart have been able, and even eBay have been able to capture a share of that growth. In the case of Apple, the expectation is that Apple's earnings will decline because Apple's revenue will decline because they haven't been able to set out a new smartphone. And so each case, Facebook people are spending a great deal more time on Facebook. So each of them has in their different way a challenge from COVID or an opportunity from COVID.
Michael, very quickly here, what are they going to do with all that cash? I mean, the critics can say, look, you're sitting on mounds of cash that could go for a social good or shareholder good. What are they doing with all that cash? You didn't advise them to do that.
I think in some cases they're waiting around to see what else they can buy, and that's a smart strategy because they are going to be up against large Asian companies that will be able to pretty much pick off anything. I mean, I think we also should expect there's going to be some transforming transactions in the next years, all depending on an administration. There are just too many businesses out there that seem to belong together. I mean, it's been rumored for so long that Apple would buy Netflix.
Right.
It's not hard to imagine.
We gotta leave it there. Michael, we're too short of a visit. We'll do this again soon. He is with Activate as well. Coming up, Kenneth Rogoff. This is Bloomberg.
As it stands right now, we are seeing too many people, for whatever reason, attending work with symptoms. That just cannot continue. Otherwise, these restrictions will be in place for longer than they should be. And I'm sorry to say, we will see more people die.
When community transmission takes place, it is inevitable that it will find its way into the more vulnerable parts of our community, and the aged care community is certainly one of those.
Certainly, these are very challenging numbers. We're at a very challenging stage with this wave. There's probably not a country in the world that has gone through a second wave that hasn't found it particularly challenging. It has very different and complex elements to it that make it quite difficult to manage.
I'm sorry to say, we will see more people die.
When community transmission
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Other tools such as income tax would require a lot of time to prepare, because if you don't have the base, this will take time. So whatever we are thinking about, we think also about implementation and ease of implementation.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
New performances and messages from
Guy Johnson in London, Tom Keane over in New York. So, Tom, when it comes to the rapidly evolving world of digital currency, central banks can no longer afford to be passive bystanders. That's according to the Group of 30, which is an international think tank of central bankers, academics and finance executives. The G30 just published a report titled Digital Currencies and Stablecoins, Risk, Opportunities and Challenges Ahead. Joining us now is Kenneth Rogoff, co-chair of the Group of 30 and obviously Harvard University professor of economics. Ken Rogoff, thank you very much indeed for your time today.
Thank you. Just to be clarified, I was co-chair of the group steering the paper, but not of the G30. I'm a member of the G30.
Okay. There's a distinct possibility that I misread that, so let's not get bogged down in that. It's a great report. It's really interesting, and it's certainly worth spending some time on. How would the policy response differ to the crisis that we face right now if we had digital currencies?
Well, that's sort of jumping way ahead. Okay, I mean, we have financial inclusion, which I think would help a lot if we did a better job with digital currencies. And there's the potential for other things. I don't think this report's about the crisis. It's about the next century, certainly the next 50 years. What is the payment system going to look like? What's the financial system going to look like? And it's not so much about the crisis response. Although, yes, it offers the opportunity for negative rates if you're asking that.
Yeah, exactly. The reason I asked the question is why do we want to get to this? What is the objective here that would make the way that we respond to financial crises, how we respond to day-to-day activity better? What is it that's going to improve if we continue down this trajectory?
Now, this is a much broader issue. So, for example, the United States has a very inefficient, with high charges and slow clearing process. How do we make it better? Many countries are concerned that the United States dominates the rails of the global financial system. We control information, we can enforce sanctions, we can do many things. And so that's because the dollar is dominant, but it's also because of the system by which we clear transactions. So this is rapidly evolving. We had Facebook announce Libra, Bitcoin, maybe won't be a global currency, but, Libra was a very important wake-up call. The Central Bank of China has introduced a nascent global currency. The innovations in this space are like we haven't seen in 2 centuries. I mean, it's the first time there's really a challenge to the standard central bank model. And we feel there's a lot going on faster than maybe many central bankers realize, Treasury officials, and we try to raise some issues that they might think about, that it's not obvious what direction to go or what different countries should do.
Ken, we're thrilled to have you with us today, and particularly with you and Professor Rajan of Chicago and the rest of your team at Group of 30, frankly bringing forward the courage of your book, The Curse of Cash, from years ago. Where are we now? I mean, this report to me is almost Curse of Cash Volume 2. And one evidence, Ken Rogoff, is I see in the pandemic, the Mint is saying there's not enough coins out there in the United States. And that may be because of the virus, not because of the virus. How close are we to the Rogoff near cashless society? We're thrilled to have you with us today.
Okay, so first of all, this is I just want to clarify, this is a fairly technical report aimed at central banks and treasuries, and it's not a recommending anything besides the issues that they should look at. But there's no question, Tom, that COVID-19 has accelerated the move away from cash in legal tax-compliant transactions. And that's one of the things that's pushed central bankers along to start talking about digital currencies. They want to provide a substitute. But there's also been a lot of innovation. How close are we? Well, I think as better things come along, it's going to happen faster. In China, they are moving full speed towards a much less cash society. They have introduced and we discussed their ideas in the report. We have a contribution from them. They're looking to replace cash, and they have a very clever idea where they're not trying to explode the system. They're trying to preserve the central bank system, but instead of getting paper currency, you get digital currency. And of course, that's already going on in China. However far along Sweden is in the curve and the U.S. is in the curve, China is farther.
Ken, I've got a Segui here, as they do, and I've got to say Ken Rogoff goes into EC 10 with Jason Furman this fall at Harvard, and you're going to say this time is different. We have a World War II deficit. Does the magnitude of this fiscal stimulus concern you?
I think we're, in chess terminology, playing forced moves. I think we're in a horrible situation. I think the pandemic's going to get worse before it's get better. We have not felt the full economic effects, and I think it's coming back to other parts of the world. That's why you have deep pockets. That's what you use debt for. This is a very sensible use of debt. It doesn't mean that everything we're doing is sensible. I mean, why aren't we wearing masks? Why isn't some of the stimulus money invested in, giving incentive support to everyone wearing masks? That obviously would save a lot more money than anything they're doing. But certainly, is this a time to worry about the debt? I would say absolutely not. There are long-run costs, and I think all the literature has supported that idea. The idea that it's a free lunch, I think, is nonsense. But the costs right now are huge. This is when you want to be paying for it. This is sensible. I favor the larger end of the different ideas being discussed in Washington. I think they're dreaming if they think this is going to be over by the end of 2020.
We certainly heard that from Chairman Powell yesterday as well. Ken Rogoff, you have talked about the courage to do an amplitude, a greater depth of negative interest rates. Will we see negative interest rates in the United States of America?
Oh, eventually, if the level of global interest rates stay this low. Right now, there's very little normal monetary policy can do, and they're essentially executing a form of fiscal policy. Much of what they're doing, the Treasury could perfectly well do. They're guaranteeing debt. They're changing the maturity structure of debt. But this is not central bank policy. It's necessary. Everything they're doing is great. But eventually, when we get out of this, whenever that is, I think we'll still have very slow growth, many problems, just like we did after the financial crisis, and they'll want to do something to stimulate the economy, and they'll be doing fiscal policy full blast, but I don't think it'll be enough, and I think negative interest rates would be a market-oriented approach to trying to stimulate the economy. We'll almost surely see it around the world, unless, of course, something happens that makes global interest rates spike. We don't anticipate that. But then, for better or for worse, it wouldn't be something we'd be thinking about.
Professor Rogoff of Harvard University and the Group of 30, thank you very much indeed for your time today. Let's pick it up. Let's figure out what's happening around the world. Here with our Bloomberg First Word News is Rudy Kugupta.
Thanks, Guy. The Trump administration and congressional Democrats are no closer to a compromise on a virus relief plan. The pressure to act is building. Enhanced unemployment insurance for millions of Americans is running out this week. White House Chief of Staff Mark Meadows sees little chance of a stopgap deal that would cover only those jobless benefits. There's an agreement for federal agents to leave Portland, Oregon. There's a disagreement about when. Oregon's Governor Kate Brown says the agents will begin leaving today, but acting Homeland Security Chief Chad Wolf says there will be no pullout until it's clear that local law enforcement can prevent violence at the federal courthouse. That's been the target of angry protesters. Supreme Court Justice Ruth Bader Ginsburg is in New York City Hospital. She's undergone what's called a minimally invasive procedure to address an issue with a stent in a bile duct. Ginsburg is 87. She was hospitalized earlier this month to clean out the stent. Ginsburg recently disclosed she was diagnosed with a 5th bout of cancer. In Hong Kong, the government has barred 12 pro-democracy activists from running in the upcoming Legislative Council elections. It says they didn't comply with requirements. One of those is support for the national security law passed last month. The move came hours after Hong Kong police arrested 4 student activists for making online comments that allegedly violated that law. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy, Tom.
All right, Ritika, thanks so much. Yesterday we talked to Dennis Gartman about his miraculous call, Gold to the Moon. Now we follow up with someone we mentioned yesterday. Jeffrey Curry will join us from Goldman Sachs. And yes, he too optimistic on the precious metals. Stay with us. This is Bloomberg. Futures deteriorate -32.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Last year, we took you inside the political turmoil gripping Hong Kong. This year, Beijing tightened its position with a new national security law. Will this jeopardize Hong Kong's position as a global financial center? And will China face the consequences from abroad? I'm Stephen Engel. We take a second look at the crisis facing the city in a Bloomberg Television special, Hong Kong on Edge 2.
Surveillance. Good morning, everyone. Guy Johnson and Tom Keene. Right now on gold, Jeffrey Curry of Goldman Sachs. Let's get right to it. Jeff, you have been very successful here in this call. And what I see is every other pundit saying it's just simply the real interest rate. Am I right that to you it's much more than just an interest rate analog?
Well, it's really three story. One is interest rate, which you're referring to. We call that
developed market investment demand. We call it the fear demand. As real go down because people are worried about the future, the fear demand for gold increases. The second leg is what we call wealth effect. That's tied to the U.S. dollar. So with strong economic growth in places like China and the emerging markets, the dollar begins to weaken, purchasing power increases, and then they demand more gold, that physical demand. That demand got hit really hard, squeezed out by the demand in developed markets, but we're seeing signs it's beginning to recover. The third leg, the biggest one of the three when we look further out, is tail risk inflation. And when we look at what's going on right now, clearly it's a deflationary type of environment right now, but the more debt accumulation we have right now based upon anchored inflation expectations, the higher the probability of some event further down the road. And I want to emphasize here is that asset managers care about the level of inflation. Economists, central bankers care about the changes in inflation. Why do I mean about the level of inflation? If inflation goes to 3%, bond portfolios paying 3 to 4% have a really serious problem. And I think that's really the key point here. When we start to think about tail risk inflation is that it's not something today, it's further down the road.
Dennis Garbin was quite eloquent yesterday, and he, like you, has had a wonderful ride with gold about saying you see it everywhere now. The froth in retail on gold is clearly evident. What does that signal to you?
To 2011, when we peaked out at 1,900 in the last cycle, gold was, week after week, Bloomberg's top consensus trade. And the market got longer and longer and longer because the underlying fundamentals justified it. And why is that we had a severely weakening that wealth effect going on like 08.
I think we might have just lost Jeff Curry there, Goldman Sachs Global Head of Commodities Research. If you want to kind of read something interesting on what is happening, check out Eddie van der Volt's notes on the Markets Live blog on the Bloomberg terminal, talking about gold entering a mania that makes it tough to time exactly when the top could be coming through. European markets continue to struggle. There you go. You've got the Stock 600 down by 1.5%. Euro dollar, interestingly, after a day when we saw Powell signaling potential for the dollar to slide even further, we actually have a dollar bid today, but we're kind of in a risk-off kind of mentality. Airbus flying a little higher today, trying to manage the cash burn in the second half, but Lloyd's painting a very bleak picture of what is happening in the UK economy. Coming up, we're going to talk to Jeff Miller, Halliburton's CEO. Looking forward to that conversation. 10:30 a.m. in New York, 3:30 p.m. in London with Alex Steele and myself. We'll certainly be addressing what is happening in terms of the service side of this sector. That's coming up. This is Bloomberg.
coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Guy Johnson in London, Tom Keane over in New York. This is Surveillance. We're back with Jeff Curry, Goldman Sachs Global Head of Commodities Research, joining us on the line. Jeff, we were talking about gold just a few moments ago. Let's carry on that conversation. Do I sell gold if I see positive news on a vaccine?
Is the low real interest rates. And that's unlikely to change anytime in the near future. When we do get a vaccine, you're still dealing with the overhang from and economic activity. I'm not going to say you're not going to see a trend go back, but the key downside is an interesting time in the near future.
Okay, this is not going to work out today, which is a great disappointment because, to be honest, Jeff is one of my favourite guests to talk to, and particularly at a time when we are seeing gold doing so well. Let's talk about what is happening in the markets right now. We are clearly in the midst of earnings season. Is that earnings season justifying the valuations that we are seeing? Well, certainly the market has been so focused on tech of late that it's going to be fascinating to see the big reports coming out a little bit later on from the tech space. Are we going to see the high bar that has been delivered in terms of market expectations actually being beaten? We're also going to be talking a lot about what is happening in the pharmaceutical space as well. Eli Lilly's CFO is going to be joining us a little bit later on. That conversation at 11 a.m. in New York. Let's talk about what's happening in Hong Kong. 4 people claiming to be students have been arrested for breaching the national security law in Hong Kong. That's as Beijing says the legislation will bring stability to the city, a city that they say is caught in turmoil. Bloomberg's Stephen Engel has delved deeper into these issues in our series Hong Kong on the Edge.
I honestly feel that at the end of the day, at the moment, we're on like an airplane with a lot of turbulence. Everybody's holding on, waiting for the plane to land. But in most cases, the plane lands safely.
Or waiting for it to crash.
Yeah, or waiting for it to crash. But I honestly feel that this airplane is not going to crash because China needs Hong Kong. They need an open Hong Kong. They're not going to change the mode here. They just want to keep it safe. They want to make it stronger.
Beijing surely, though, doesn't want a stronger pro-democracy camp. Before the passage of the national security law, pan-Democrat lawmakers had been accused of using disruptive and filibustering tactics while fostering anti-China sentiment. Playing cards, similar to those the U.S. government put out in Iraq during the Second Gulf War, have circulated here, singling out the faces of pro-democracy advocates, including the human rights lawyer Albert Ho, the Ace of Hearts.
There will be a lot of scaring tactics. Many people are being scared away. You know, they want to defeat you without using any force or even without waging any war. That is the way that the Chinese play, you know, the game.
If I sit here and say, no, I will never be arrested, you say, Emily Lau, were you born yesterday? You live under communist rule. How dare you say a thing? I've never said that, even in 1997. But neither did I predict that, oh, I will be arrested tomorrow. No, we live under Chinese rule. So everything that happened, would not surprise us because that's the way they behave to their own people. But we will stay and fight.
I don't think I'm going to leave, even though I know I'm facing imminent risk being put into jail. Because, you know, if I become scared, all the other people will all the more become, you know, very scared. Then the whole community will be stifled.
I have no plan to move Hong Kong.
and we need to fight until the last minute. According to the anti-subversion regulation, before the national security law implemented in Hong Kong, this interview is legal. But after the national security law implemented in Hong Kong, this interview might be illegal, and not only arresting me, even arrest you.
Freedom of speech is indeed limited by this new law, but it is mainly the freedom to advocate Hong Kong independence or the freedom to advocate overthrowing the Chinese Communist Party. So I must admit that there is some limitation of freedom of speech.
Is freedom of the press under threat?
No.
No.
No, unless they involve in secession, subversion, or terrorist activities.
But do people have to be worried about what they post on Facebook, what they post on social media, what companies and their employees post?
Yes, I don't think you have the fiduciary obligation for what criminal offense your staff commits. But the point is, if you are not involved with, if you have no intention to carry out secession, subversion, and terrorist acts, then what have you to fear about?
So what you got to do now, that was the taster, is tune into the full thing. On Bloomberg Television, Hong Kong on the Edge 2, basically covering the social and economic upheaval that we've seen in Hong Kong over the last few months. 5 a.m. London time, noon in Hong Kong. It's certainly one that is worth spending a little bit of time thinking about. Let me kind of run you through some of the price action that we're seeing right now. I just want to update you as we're approaching 7 a.m. in New York. Things are really quite ugly now in terms of the European equity market session. The DAX is down a full 3%. The FTSE 100 in London down just over 2%. You've got the CAC down circa 2% as well. The Italian market down nearly 3%. But just looking at the fair value over in the United States on my Bloomberg, down by 1.2% on the S&P. We're going to talk to Lilly's CFO a little bit later on. That conversation at 11 a.m. in New York, 4 p.m. in London. It's a busy, busy day for earnings. Plenty of great coverage coming up. This is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on you can keep on.
The Fed has pretty much done its job. It's gotten rid of the dislocations in the markets, and it's gotten borrowing costs to incredibly low levels. And so there really isn't much more that the Fed can do right now.
If the market is okay with the inflation rate running above 2%, so is the Fed. If the inflation rate goes above 2% and the bond market sells off hard on that news, then the Fed will be forced to change.
Until people really start to feel very comfortable about where we are from a COVID perspective, I think it probably winds up sitting in savings at this point.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene, the smaller risk aversion on a Thursday morning. Equities lower, bonds bid, the dollar stronger.
Follow on from what we saw yesterday, John, from the Fed meeting. There's no question Chairman Powell changed this market. If I had to say one thing, John, and I know it'll be a theme for you through the week and with the claims today really driving forward that conversation, is the real yield, the inflation-adjusted yield is through 2012 levels, and it shows not the gloom or this word dour that's used with the Fed, but just the absolute readjustment that's going on.
The data coming at 8:30 Eastern. Lisa Abramowitz, you've got to believe the GDP print is for the economic historians and the jobless claims are for this market.
That's exactly where I was going to go. At 8:30 a.m. Eastern, we're going to be getting that GDP report, the worst in history, and it is history. No one is really going to pay attention to that from a market perspective. The jobless claims expected to increase from last week, and also the continuing claims expected to increase. Interesting to watch that. Also today, very much in focus is tech earnings. Aftermarket, we're getting earnings from Alphabet, Apple, and Amazon. This follows the hearings yesterday. And also today, John, stimulus talks are continuing in Washington, D.C. with Steve Mnuchin and Mark Meadows. And we also have Nancy Pelosi down there. This comes after Mark Meadows, chief of staff of President Trump, came out yesterday and said they're nowhere close to a deal. The $600 unemployment benefit runs out tomorrow, John.
The talks go nowhere. It's not even funny. Let's get to the price action in the equity market. We break down on S&P 500 futures, down around about 1% on the S&P. In the bond market, bonds bid yields lower, down 2 basis points on a 10-year to 0.56%. In the FX market, the euro had a little taste of 118 yesterday. Euro dollar back down to 117.49. And Tom Keene, the mystery of the moment in foreign exchange for me. Can we get the chart up, please? Cable, what is the pound doing stronger when you see the dollar stronger broad base? Tom, this is a mystery for me. The pound has been leading the pack when we've had dollar weakness, and it's been outperforming when we've got dollar strength. Cable through 130.
The tenor here of the euro, sterling, and the dollar is extraordinary, John, and I particularly overlay that with the GDP statistics. John, we've got to stop and make clear for our American audience that we count GDP here differently than you people do over there. Negative 30% here is like negative 8 or 9% over there. Did I do that right, John?
Dare I say, Tom, that we do it the right way? And I think that the way you do it here is a little bit misleading. When we get that annualized GDP print at 8:30 Eastern, basically what it means is negative 10%. I don't know why we annualize this figure in America, Tom. It doesn't make sense to me.
I brought this up with Chairman Greenspan, and I was shown the Greenspanian door.
I imagine you were. I imagine you were. We'll debate that a little bit later this morning. Equities down then, 34 on the S&P, off by a little more than 1%. He has been a bull through this bull market. Ben Laidler, Tower Hudson Research CEO, joins us now. Ben, you turn from bullish to that word that when the bulls start to pull back a little bit, they love to write. Consolidation. What does consolidation mean for you right now?
I do put a sort of plus after it, to be fair, because I do think all the risks is still on the upside. But I would hope we get a consolidation. And I actually do think markets are essentially where they are at the beginning of June, right? So I do think, bigger picture, we have sort of been consolidating. I do think that's a very healthy thing. This market has rallied over 40%. I mean, it's not going to head to the moon. We're on 23 times forward earnings already. I do think a little bit of a breather, allow earnings to recover here, or at least expectations to begin to recover, which I think is happening in second quarter earnings. And I think we're very well supported with bonds where they are, with the growth recovery outlook where it is. And I do think there are a number of sort of upside catalysts sort of out there, whether it's the fiscal stimulus out of Congress, the stabilization we're seeing in virus cases, whatever it is. So, broadly a consolidation, I think that's healthy, but I think all the risk definitely remains on the upside.
I mean, Ben, this is fascinating. You mentioned go to the moon. Later in the hour, folks, we're going to go to Mars. They're going to launch the rover off of Cape Canaveral. That's about innovation, Ben Laidler. Is this market lift out 6 months, or for that matter, out 6 years? Can it be extended beyond innovative technology companies?
Yeah, I think you're seeing that. I think the story of this rally is exactly that. 2/3 of the market, whether in the US or globally, earnings are sort of okay. They're down 10, 15%. It's that 1/3 of the market, those sort of deep cyclicals and financials where earnings are sort of being vaporized. And most of that 1/3 is just a story of accelerating tech adoption, the strong getting stronger. And we got a taste of that in the congressional sort of testimony yesterday. It's clearly not a one-way street, but I do think the sort of foundation of this rally has been sort of tech, sort of broadly defined, sort of tech-enabled businesses are doing very well here, and I think they sort of remain the future. And I completely disagree with those that think we're in some sort of bubble here. I have no problem with a lot of these valuations and the growth outlook.
Ben, you said that one potential upside surprise would be more fiscal stimulus, and yet here we are. We're heading into tomorrow's deadline for the $600 enhanced unemployment benefit, with no deal on sight, and yet it seems like markets are taking this in stride because they have priced in the extension of these benefits. What's the upside surprise?
I think we get a bigger deal than, I think we get a $2 trillion deal rather than a $1 trillion deal. I think actually, the stars are aligned a little bit behind the scenes. I think everybody agrees we need something. I think there's quite a lot of agreement on some of the packages that we need. I think interest politically, we have the election coming up, which I think is piling pressure on everybody to do something. And I guess now, relative to 3 months ago, I think the virus issues are much more in the red states than the blue states. So I think you put all that together, and I think, there's the ingredients for a deal. And I think when all is said and done, we get a bigger deal than maybe people think right now.
Ben, when we talk to economists and central bankers, the policymakers, they might say the balance of risk is tilted to the downside. When I speak to you, I hear the balance of risk is tilted to the upside. Why is that the case for you, Ben?
Well, I'm not the economist, but I think what's been fascinating about sort of the last month or so is you've had this huge spike in virus cases in the US, and the data has been incredibly resilient. And you've seen that actually globally as well. And I think that really speaks to the fact that, people are getting on with their lives, people are adapting, the death rate's been coming down, we're getting sort of better at managing. We're getting better at managing in this, and I think that has been a huge takeaway. And now we're beginning to see, tentatively, those US virus cases on a sort of rolling basis begin to sort of come down. So if that's true, then I do think there's more resilience to this recovery than maybe people think.
This was what was interesting yesterday, Tom, from the chairman of the Federal Reserve. I thought it was really interesting that he refused to say anything with conviction about the degree to which he thought this recovery had slowed down. He declined the opportunity to say it a couple of times, and I was actually surprised by that because I thought he'd be teeing up the next move from the Fed with that in mind.
John, you're right. He wasn't doing a market forecast, but to be very clear here, Chairman Powell was stunning in his dovishness and the way he linked over to the urgency of fiscal stimulus. I'll agree, he didn't give a point figure on GDP, but he made real clear this is virus specific.
Well, the test is about to play out this morning, Ben, and I think that's what's interesting. At 8:30 Eastern, we'll be getting jobless claims data that shows the pace of this recovery is slowing. That's what everybody expects. Now, if we get something better than that, fantastic. But if we do get what most people expect, Ben, what does it mean for you?
So I think a couple of things. So the labour market is absolutely stalling here, and that is not a good thing. I think that piles pressure on Congress to come to a deal, as does this historic GDP number, which I think we're going to sort of ignore because it's backward looking, and the data sensors tell us we've got some sort of recovery going on. But it's a staggering number. But I think you take those two things together, it piles pressure on for more fiscal stimulus. But again, I think the message from the near-term data is this is a stabilization, not a we're not rolling over yet. And if I marry that up with the sort of tentative virus data that we're seeing, again, I think this is a sort of stabilization which may begin to reaccelerate. Obviously not at the degree that we've seen, given that we've come from a sort of a total lockdown. But again, I think the incremental data point is going to remain positive, and I think that's supportive for markets here.
Ben, this is a really complicated moment economically. From a market perspective, is it much simpler? Is it all about yields at record lows for 2- and 5-year maturities for treasuries, 10-year yields heading south? Also, this idea with low yields, the valuations for stocks still look good?
I do think that's a huge component here. I mean, we're on 23 times earnings. If I put current bond yields and the Fed's long-term GDP growth forecast into our sort of fair value model, I get 22.5 times, right? So that gives you an idea of the sort of level of support here. Dividend yields are above bond yields for essentially the first time ever. That sort of inverted bond yield PE is 140 times. That sort of TINA trade is sort of alive and well, and I think is a real anchor to valuations here while we wait for earnings to begin to recover. And I think we're seeing that in second quarter. Earnings revision ratios have turned up, and I think we just need to give that a bit more time.
Hey, Ben, great to catch up with you, sir. As always, Ben Lader there of Tower Hudson Research. Big day for big tech earnings a little bit later. Tom Keene will head down to Washington, D.C. to catch up with Kevin Cirilli in just a moment. Can we reflect on Mark Zuckerberg straight out of the gate yesterday, throwing everyone under the bus and saying the following: the most popular messaging service in the US is iMessage, the fastest growing app is TikTok, the most popular app for video is YouTube, the fastest growing ads platform is Amazon, the largest ads platform is Google. Tom, do you remember the Mark Zuckerbergs that we used to go to school with? You'd get called into the headmaster's office and they'd just let it all out and throw everyone under the bus. That was Mark Zuckerberg yesterday in these hearings.
Well, first of all, they're all well-dressed. They all look like you, John. They got the little skinny tie thing going on, and they're all in their best behavior, unlike you. But what was amazing to me is how each guy is different and how each story is different. And clearly making the news yesterday, no news to any of our viewers or listeners, is Jeff Bezos was basically invisible for the first hour.
He did a good job of staying invisible, I've got to say, Tom.
I try to do that on this show.
Good luck. You don't succeed very often at all. Coming up later on this program, we'll catch up with Kevin Cirilli. Up later as well, Raghuram Rajan, former RBI governor, now from the Chicago Booth School of Business. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Negotiations resume today on a compromised coronavirus relief plan. The Trump administration and congressional Democrats are nowhere close to an agreement. They're under pressure because millions of Americans will lose their supplemental unemployment insurance this week. White House Chief of Staff Mark Meadows sees little chance for a stopgap measure that would extend those benefits. The number of Americans killed by the coronavirus has now gone over 150,000. Death toll surged to records in some of the hardest hit states, California, Florida, and Texas. Still, the new wave of infections that began in June appears to have leveled off. And we're about to find out how the bad got the U.S. economy in the second quarter. GDP figures are out at 8:30 a.m. New York time, and they're expected to show the economy shrank at an annualized rate of 34.8%. Consumer spending ground to a halt in April because of coronavirus lockdowns. Meanwhile, Germany's economy plunged into a record slump in the second quarter. Output fell 10.1%. That's the most since Germany went to quarterly GDP reports in 1970. Coronavirus restrictions led to declines in exports, consumer spending, and investment. Recent indicators signal that growth has returned, but unemployment remains high. And AB InBev sold more beer than expected in the second quarter. That's despite the coronavirus lockdown. The parent of Budweiser returned to growth in June after crashing by about 1/3 earlier in the quarter. AB InBev says investments in digital marketing and e-commerce paid off. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our fear is that the labor economy is going to start to stall. As we realize that we're reopening to a new normal, there'll be parts of the labor economy that cannot get back to normal.
Well, we see that in the data this morning from New York. Good morning. That was Priya Misra of TD Securities alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Here's your price action. 2 hours and 12 minutes out from the opening bell in New York City. Equities down 30, off by 0.9%. Some risk aversion this morning. You see it reflected in bonds. Yields heading south by 2 basis points. 0.56% is your yield on a US 10-year. And Tom Keene, a 118 print on euro dollar yesterday. Bit of consolidation for the US dollar now. Dollar strength this morning. Euro dollar back to 117. 0.51.
Maybe in foreign exchange, but in bonds, we are speaking now. The 2-year yield just out to 2 lows to 4 digits, 0.1211, and the 5-year yield historic lows. That is a market speaking. The 2-year chart, for those of you on Bloomberg Radio, I put it out yesterday on Twitter. I'll get to it again today. The markets are speaking. And yesterday, Chairman Powell spoke as well. They're both saying the same thing, stimulus now. Joining us, our chief stimulus correspondent, Kevin Cirilli in Washington. Okay, Kevin, Tuesday, waste of time. Wednesday, waste of time. When do the adults step into the room and start compromising?
Likely within the next 48 hours. Yesterday, President Trump saying to reporters at the White House before taking off for Texas that they are still a worlds apart in terms of where the negotiations are. He was joined by Treasury Secretary Steven Mnuchin as well, who has really been tasked with trying to get some type of deal with Speaker Pelosi, as well as the president's chief of staff, Mark Meadows. But behind the scenes, I'm told that on the issue of providing aid to state and local governments, that could be a potential area for there to be some compromise over the next 48 hours.
Kevin Cirilli, an ancient question. I lived it as a kid. You're going to live it right now. We can fund rovers to Mars. We can fund helicopters to Mars. Why can't we fund people with no jobs?
Well, you know, I think in terms of where the ideological debate here is that Republicans would make the case that they want to incentivize every American worker who is able to be able to have a job, a good paying job. And I think that from the structural standpoint, as we head into the fourth quarter and there's horrific GDP estimates that are coming out for the numbers in the second quarter, that a lot of the tax credit debate now is also being had in the Democratic Party between progressives and centrists in the Democratic Party, especially as it relates to providing some tax relief to companies, medium and small size companies who want to keep employees on their payroll. That's where, quite honestly, when I spoke with Republicans yesterday, they feel they could be able to pick off some Democratic support.
Kevin, as Tom mentioned, the lack of urgency is absolutely phenomenal. The president comes across as very relaxed, but he says the right things. Take a listen to this. He said yesterday, we will work out the things we have to on evictions so people don't get evicted, to work on payments to the people and all the rest of it. Kevin, he is relaxed about this at the moment. I do wonder when we start to hear some urgency.
You know, I think that in Washington, D.C., Jonathan, this is a strategy that was deployed for over the past decade, really, and is really an illustration of the McConnell and Pelosi era, so it be, even dating back to the Obama years, in the sense that they create these cliffs in order to really create a sense of urgency, even if it's a false one. So I think the president, from his perspective, is looking at the deadlines that have been set of Friday and August recess, and from that vantage point, things are moving according to plan. However, obviously, for millions of Americans, it's not moving fast enough.
From an outsider's perspective, Kevin, it's highly confusing. You have yesterday Chief of Staff Mark Meadows coming out and saying they're nowhere close to a deal, and yet all of these political reasons are there for them to get something through. What's the sticking point? 48 hours until the enhanced unemployment benefits run out. Who are the main holdouts? What are the main issues?
So the main issues are, number one, the price tag. Secondly, the unemployment benefits. Republicans don't want to put out for those unemployment benefits, Lisa. They want to incentivize people to be able to get back to work. Democrats obviously feel strongly. And thirdly, it's funding for state and local governments. You know, in conservative states, they're looking at some of these cities, some of these progressive states, and they're saying, why should they be on the hook to balance another state's budget? So that's another very big sticking point. But at the end of the day, I mean, it really is remarkable to see how many of these people who are in the negotiations have been here before with regards to government shutdowns, with regards to raising the debt limit, for example. And I think that they're treating this particular moment as equal to that, but quite frankly, it's not the same at all in terms of the urgency outside of the Beltway.
You told us to watch Senator Thune, Kevin, and he spoke yesterday and he mentioned Plan B. It's the first time I'd heard Plan B in the last week. What is Plan B?
Plan B is to get is to raise how much money, more money that they're willing to spend, but to also continue to try to take some piecemeal approach and to kick the can down the road. And I think that a short-term type of extension where we're having this conversation in a month could be on the horizon.
I'll be fascinated to see that. Kevin, let me cut to the chase. Al Broadus of the Richmond Fed said, do it now. Ken Rogoff of Harvard said, do it now. Both these guys are esteemed conservative voices in their own way. How come the conservative experts are so far apart from the conservative theology of the Republican Party?
Elections, and we're living in the perpetual election cycle where even November 3rd and just 90 plus days is right around the corner, but people are even playing a longer game than that. But I would just note, you don't have to have a Harvard degree or an Ivy League degree to know how much people are hurting right now, and forget about the elections for a second. I think that the pressure coming from the base of the constituents is really going to push people to follow Senator Thune.
Kevin, great to catch up with you, sir.
Thank you.
As always, look forward to catching up later. Kevin Cirilli there down in Washington, D.C. Here's a stat for you, Tom. It came from Chairman Powell yesterday. 14 million, the amount of people who were in work in February who are now out of a job. You know, we keep doing these payrolls report the last couple of months. The administration will come out, do the victory lap. Tom, 14 million. There is no victory lap right now. There needs to be more assistance to address this economy.
I would go to Kathy Hochul, the Fed official from Buffalo. I'm kidding, folks, the lieutenant governor of the Empire State. She framed Buffalo at 16% unemployment and her working number in her head at 20%. How many Buffaloes are out there?
But Tom, what does she say? And we know this. States can't act counter-cyclically. The federal government can.
Well,
States will have to respond pro-cyclically if they don't get the aid. And what does that mean? It means job cuts.
Right.
It means state-level austerity.
John,
it's coming if they don't do anything.
Correct me if I'm wrong, because I'm focused on the Mars launch. But John, help me out here. I don't believe there's any state or local funding in this bill. Am I right?
We're having a serious conversation, and you're excited about the Mars launch.
I'm really excited about the Mars launch. It's a big deal for science.
When's the Mars launch?
It's scheduled for 7:50 this morning. It's without question the launch of the year.
Rockets on radio. I'm looking forward to it, Tom.
It works on radio.
We'll be doing that very shortly from New York
Good
City
morning,
this
Jet
morning.
Propulsion Lab.
Good morning to you all. Coming up on this program, Michelle Meyer of Bank of America Securities on the GDP data coming in 60 minutes time, and jobless claims as well. Struggling to keep it together. In your equity market, we're down 31. On the S&P 500, we're down 1%. Outside of that, some risk aversion. Bonds are bid, yields are lower. Tom very focused on the front end of the curve. And the dollar, after a weaker dollar, and a weaker dollar a little bit more through much of this month, the dollar's strength making a comeback this Thursday morning. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
We're always looking, and we look at things through the lens of value. And we have to see a good portfolio fit, and so there are strategic screens that we look at for any transaction. We've got a pretty high bar.
The economic data dump is 60 minutes away from New York. This is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Here's the price action, 60 minutes away from the data, 2 hours away from the opening bell. Equity futures down 1%, taking a bite out of yesterday's gains. The risk aversion reflected cross-asset worldwide. The euro is weaker, the dollar is stronger against most in G10. In the bond market, Tom, very focused on that anchored front end.
Yeah.
On a 10-year, we come in 2 basis points, 0.55% on a 10-year maturity. Tom, the data, 8:30 Eastern.
And the 2-year unanchored as well, really coming in off of Chairman Powell yesterday, John, and today further deterioration. Note price higher, the yield now 0.1211, a 0.11 yield in the 2-year would be newsmaking to say the least. Michelle Myers had a wonderful career at Bank of America Securities, head of U.S. economics now. And Michelle, John and Lisa have got some fancy pants question for you. I got a basic question that came off of David Gura of NBC News yesterday at the Powell press conference, which was a separation of America into 2 societies. They're the haves, the new haves, which are going through this pandemic, service sector, they're at home, everything's fine, let's buy the beach house, and there's a whole nother America flat on its back. And the chairman took the bait. He answered the question. Tell us about this separation right now in America.
Yeah. Hey, Tom. And I think it was a great question that David asked, and I'm glad to see that Fed Chair Powell did respond to it. And it's something that I think is really important to the Federal Reserve, the fact that we've seen this widening income inequality. It comes up in nearly every speech that Chair Powell has given. And even before COVID hit, it was critical to their Fed Listens events, this idea that we want to get a broader recovery. We want to have income creation widely spread. We want to control for the wealth inequality. And so why is that so important from a macro perspective? It's important because when you have income inequality or wealth inequality, you're not getting as strong of an aggregate spend as you can have, right? If so much of the money is concentrated in a small share of the population, that population can't possibly spend it all, right? So when you have the lower income population, which tend to be more budget constrained, tend to spend what they earn, it filters into the economy more, it multiplies, and it's a lot more favorable. And this crisis has disproportionately hit the lower income population, particularly those that are working in leisure and hospitality. That sector lost almost half of their jobs were cut as a result of COVID. Now it's been coming back. The balance in the last 2 months has been favorable, but there's still millions of workers in that population that are out of work and looking.
Michelle, you've done a tremendous job over the last couple of months with the team describing what this recovery will look like. A fall off the cliff, a bounce off the trampoline, and a climb up the rope. The long climb has started. Can you explain to our audience what you think that will look like?
So that's exactly right. Now the hard work comes, and I think it's going to be a lot more wobbly, maybe fits and starts, So you make some progress, you climb up the rope, you hit a stumbling block, you pause for a bit, maybe the economy falls back slightly. I don't think we're going to fall off again. I don't think it's a W-shaped trajectory. It's not going to be a downturn again unless there's something much more significant that happens in terms of, the path of COVID. But from here on, I think it's absolutely critical to pay attention to how consumer behavior evolves in the face of COVID risks and how the stimulus evolves, both monetary and fiscal. And right now, we're in a critical point when thinking about fiscal policy and how targeted the stimulus may or may not be in terms of reaching that population that has a higher tendency to spend that money.
On the monetary policy side of things, the Fed's going nowhere fast. Tom Keene, there is an elephant sitting on the front end of the yield curve. It is called the Federal Reserve, and a 2-year yield breaking down.
It is, and John, this is fascinating. I mean, I don't know what else to say, but, I go back to Hunt Brothers Silver. I mean, there's a point where the market starts telling institutions what to do. Michelle Meyer, is there enough power out there for markets to tell the Fed what to do?
Well, it's a tricky question because in a way, markets clearly do influence monetary policy because monetary policy and the Federal Reserve will react to financial conditions because that's the transmission of policy. Think about everything the Fed is trying to do in terms of their policies and, the commitment to low interest rates, their support for the flow of credit. The way they observe that and see if there's success is to determine how financial conditions evolve and how markets evolve. So markets can push Fed officials to some extent because it's kind of that calibration in a way. So yeah, markets right now are.
I think we've got a problem there with Michelle Meyer's connection of Bank of America Securities.
Same thing.
Michelle, bear with us as we try and re-establish that line just quickly, if you don't mind. Tom Keene, looking at that front end breaking down 0.12%. I think Lisa mentioned this earlier on the program. The 5-year space on the Treasury curve, the belly. Lisa, this is getting interesting. Low for longer is something we're told repeatedly. This market's listening. It's taking the policy rate and pushing it out along the curve into the belly.
And how is that going to help employment? And I think this is one of the big questions right now, especially with the Federal Reserve doing everything they can and gridlock in Washington, John.
Let's bring Michelle Meyer back into the conversation. Michelle, speak to that. The Federal Reserve incrementally, what are they achieving if they do more? I think we do continue to have a problem with Michelle Meyer. Michelle, I apologize for this. We're going to have to let you go. Michelle Meyer there of Bank of America Securities. Tom, Lisa poses a really important question on monetary policy, and we talked about it yesterday, the diminishing marginal return of that additional dollar of stimulus.
Absolutely.
And that is particularly important on the monetary policy side.
It really is, and you get into the fancy language, the Greek letters of gamma, where you start to get accelerations and trends. I was a little taken back, John, yesterday about how the chairman, he's got to be calm, he's got to be quiescent, as Greenspan would say, but you really got to wonder what the PhDs at the Fed are doing about the rate of change of these lower yields we're seeing. And the 10-year tip, where is it right now? My eyes are failing me. I think we're at a negative 0.98, negative 0.97. You get a one handle on the 10-year tip, a -1, John, you'll have to extend the real yield out to a 2-hour program.
I wish we could get it to 30 minutes, but Tom Keene, we're working on it, and you know that, and that's why you've brought it up. So I'm going to ignore you and carry on by talking about the bond market and the Federal Reserve. Tom, what was interesting for me, and for most people as well, and I have to admit I was surprised. We caught up with Priya Misra of TD Securities about this yesterday. I thought he would have had more to say about forward guidance. Just think about that.
Yes.
Ahead of September, I thought we'd get the tease. I didn't think we'd get the forward guidance. I just thought we'd get the tease that we're shifting towards a world where it might make sense to have state contingent forward guidance, a threshold on the unemployment rate of something well south of what we considered last time around. And that's the important factor here. Last time they did this, at the back end of 2012, they introduced forward guidance and basically said rates go nowhere, at least until we go through 6.5% on the unemployment rate. And like human beings, policymakers are conditioned by experience, and they've been conditioned by the last 10 years. And the last 10 years has told them they can allow that unemployment rate to go a whole lot lower. So as we go into August and we wait for that virtual Jackson Hole, Tom, and we get set up for that September meeting, that's what I want to know.
Yeah.
If they go with state contingent forward guidance, how low does that unemployment threshold go?
I want to go with high-frequency data. I mean, I want to go back to last weekend, which, frankly, John, seems ages ago, the way the news flow is going this week. And it's just, what's the high-frequency data? What's the GDP math going to be today? What are we going to see at 8:30 with this claims number? To me, that gets you to your forward guidance analysis quicker than anything.
Well, the high-frequency data is really clear. At least things are slowing down. The recovery, the pace of the pickup is slowing down. In some areas, it's stalling. We saw it in claims last week. We're expected to see it in claims again this week. And for me, it goes back to another thing. The second thing I was surprised about yesterday, Lisa, was the fact that he didn't have any strong convictions about the degree to which this economy had slowed down, when the data backs up a strong argument to say it has, by a fair bit.
He was very clear. They're watching the virus. He was also very clear. We're going to give it all that we've got. I still don't understand what their ammunition is, though, especially as we get second quarter earnings that company after company announce layoffs, John.
8:30 Eastern, the data's coming. Bloomberg's Michael McKee with us now. Hey, Mike, walk us through what we can expect at 8:30 Eastern, please.
Well, it's going to be historic, John. That's all we can tell you. I mean, we're expecting a 34.5% annualized drop in GDP. If we see GDP drop of that size, that would be about a 10% drop in the non-annualized numbers. So the economy contracted by about 10% in the second quarter is what that would tell us. And that's what happened in Germany overnight. They had a 10.1% contraction. So a really dismal second quarter. That's already priced into the markets. The number that everybody's probably going to be watching, given what you were just talking about, initial jobless claims. Do they continue to rise? Do they continue to validate the idea that Jay Powell was talking about yesterday, that we are seeing a slowdown in the economy? The forecast is for 1,445,000. So that's about another 40,000 jobless claims increase.
Mike McKee, does Chairman Powell have the president's back? I mean, fiscal stimulus is about the Senate, it's about the House. But was he really speaking yesterday to the White House to give them courage to push forward a stimulus larger?
He was probably speaking to everybody in Washington, in the two branches of government that are negotiating this. The real issue is in the Republican Party up on Capitol Hill. They're the ones that are divided. The president is on the side of doing as much as possible. They'd like to get as big a stimulus as they can because they'd like the economy to be growing again by the time he's voted on the possibility of a second term. So you got to look to the members of Congress, and there is some hope, I think, at the Fed and other places, that if we get a really terrible GDP number today, that would help push things along.
Can you talk to the churn under the jobs number, the idea of where the decline is coming from? Is it coming from a slowdown in the reopening or an increase in layoffs that are more permanent among a lot of bigger companies?
It's beginning to be a mix. I think a lot of people are thinking that what's happened is we saved a lot of jobs with the PPP program, but that money's starting to run out now. And so as more companies come back, find out either they can't make it because they're no longer viable, and as you say, we have permanent layoffs, and then other companies who don't have PPP money anymore and can't stay open, even if they think they can make it, you get a combination of that that's leading to layoffs. And at the same time, you have all of the personal services kinds of places that governors have shut down, the restaurants and bars and gyms and things like that. So it's a combination.
Mike, let's see you when the data drops. 48 minutes away. Looking forward to catching up. Michael McKee there, Bloomberg's very own, and our finest on this economy. Coming up on this program, Rohit Kulkarni, MKM Partners Executive Director from New York City this morning, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. A massive morning for the economic data in America. It is just around the corner. A massive afternoon for the earnings. Tech earnings, 1/3 there and thereabouts of the NASDAQ 100 reporting earnings after the closing bell. From New York City, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The Trump administration and congressional Democrats are no closer to a compromise on a virus relief plan. The pressure to act is building. Enhanced unemployment insurance for millions of Americans is running out this week. White House Chief of Staff Mark Meadows sees little chance of a stopgap deal that would cover only those jobless benefits. There's an agreement for federal agents to leave Portland, Oregon. There's a disagreement about when, though. Oregon's Governor Kate Brown says the agents will begin leaving today, but acting Homeland Security Chief Chad Wolf says there will be no pullout until it's clear that local law enforcement can prevent violence at the federal courthouse. There's been the target of angry protesters. Supreme Court Justice Ruth Bader Ginsburg is in a New York City hospital. She's undergone what's called a minimally invasive procedure to address an issue with a stent in a bile duct. Ginsburg is 87. She was hospitalized earlier this month to clean out the stent. Ginsburg recently disclosed she was diagnosed with a 5th bout of cancer. In Hong Kong, the government has barred 12 pro-democracy activists from running in the upcoming Legislative Council elections. It says they didn't comply with requirements. One of those is support for the national security law passed last month. The move came hours after Hong Kong police arrested 4 student activists for making online comments that allegedly violated that law. And shares of UPS are rising. The package delivery service posted second quarter earnings and revenue that beat the highest estimates. UPS says the results were driven in part by the demand that emerged from the coronavirus pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Order placed to buy euro at 117.49.
Sold only our own inventory. It was a very controversial decision inside the company to invite third-party sellers to come into what is really our most valuable retail real estate, our product.
I have to remove order to buy euro. It moved too fast. Yeah.
in any market or in any product category where we do business.
History shows that if we don't keep innovating, someone will replace every company here today.
Did you get the message? We're not dominant. We face competitive forces. The message from big tech to Congress in the last 24 hours. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, my new approach to questions I don't like. I disagree with that characterization. I'll get my office to get back to yours. Yeah. Can you imagine spending thousands of dollars for PR training just for that one line?
How many people do you think were involved yesterday just in picking out the color of the ties?
I think thousands, Tom. I mean, I'd love to know how many people were sitting around those individuals in those offices, giving them the nod and giving them hand signals.
We could beat it to death right now, John, but let's not do that, because we've got to get to this afternoon where they will reaffirm revenue generation and the ability to generate free cash flow. Rohit Kulkarni joins us right now, working with Michael Dart at MKM Partners. Rohit, what are we going to see from these earnings, and particularly given the pandemic, what will we see in revenue dynamics?
Hey, thank you for having me. And I think all the big tech execs would be relieved that they were able to schedule this before their earnings. I think, as in, I wouldn't like to be in their shoes to be seen as profiteering from the pandemic and having to answer even an extra layer of questions after earnings. So that's what I expect. As in, all three names, Amazon, Google, and Facebook, have outperformed the market. Expectations are high, and all three, I think, would have upside to what Street is modeling. So they should have a higher level of profits. They should highlight how the recovery looks like. Every stock has a lot of moving parts. We can go into that, but I feel Amazon has the highest level of upside to what Street is modeling, followed by Facebook, followed by Google. What the stocks do after that, we can talk about that.
Rohit, I heard a lot of great lines for the campaign highlight reel for some of these politicians yesterday. I didn't hear much that would make me worried about these businesses being forced to transform anytime soon. Did you?
I didn't either. As in, what was heartening to me was the regulators seem to have done a lot of homework over the last 12, 13 months. They had a lot of interesting anecdotes, emails to point out, so on and so forth. But I think from a fundamental change in the business model, what we learned and what we actually learned new, I think, as in, it was just another day in 2020. We didn't, I didn't see.
Well, Rohit, let's be clear. Another day in 2020 is not a good thing.
As in, what I would say is another day in the lives of these businesses, as in continue to grow and continue to take share away from other businesses.
Some of this is the engineering of the moment, and what you are seeing right now, folks, is from the Jet Propulsion Lab, the extraordinary follow-on to Curiosity and Mars. This is Perseverance of the rover with a brand new fangled helicopter Ingenuity, which will go to Mars. This is extraordinary. It will take 7 months to get there, not 3 days like to the moon. They've got to get the optimal path to get out to Mars with the least amount of energy. And they do this after the smashing success of Curiosity. And Rohit, this really comes down to the engineering of America. This toy, this rover, has 13 computers on board. What did Silicon Valley do? What did JPL do? What did our nation do to get that computer edge?
At this time in flight, the SRB chambers. Hey guys, as in, while I would love to chat and geek out on space tech, as in hard to comment on that. Probably we can talk on big tech and their earnings going forward.
Well, big tech, I think what Tom speaks to is important. It's innovation in America, and what these big tech CEOs were trying to push yesterday is innovation in America and big tech in America. And the word China came up again and again from the likes of Mark Zuckerberg and Jeff Bezos as well. Do you think that resonated with Congress? There's two hot button issues here: big tech and what we should do about it, and the Chinese Communist Party and what we should do about it. And they're trying to conflate the two. Do you think that resonated?
As in, you were spot on. As in, I think they are trying to conflate the two in terms of direct business impact. As you know, like Google and Facebook are not in China, so they have already borne the brunt, and they don't have many direct ties into what Chinese Communist Party does on a day-to-day basis as far as their business is concerned. Amazon has exposure to China, but I think they were trying to do the smart thing of trying to conflate these two things and trying to bring in more kind of political kind of say into the conversation. But from a business standpoint, you're spot on, as in there is no direct impact, positive or negative. That's already in the past. Any new regulations, any new kind of hurdles that U.S. regulators bring on Chinese companies could be only a positive for these big tech companies.
In the spirit of innovation, as we watch this rocket today, Rohit, I'd love your sense of where the innovation in Amazon really is that will continue to add to their profitability. Is it now a cloud company and not a retail company? And is that what analysts are looking for at earnings today?
Yeah, exactly. And I was surprised that there was not a lot of discussion on the cloud aspect of the company, as in that's almost kind of 40% of the market cap of the company today, in my opinion. And as we look ahead, I think that's where the greatest amount of innovation lies. What Amazon is doing with machine learning and AI, and what that could, how that could shape the things of innovation in times to come. It's a three-horse race in cloud computing. It's at the end of the day, they're competing against Microsoft Azure and Google on the Google Cloud. Amazon has higher market share, so what Microsoft said on their call would implies to what Amazon is going to say on the call. Yeah. Cloud is accelerating in the pandemic, and that's a tailwind that Amazon is going to benefit from over the next, not just 3 months, but many, many years to come.
Rohit Kulkarni, thank you so much with MKM. If you're just joining us on Bloomberg Radio, on Bloomberg Television, for radio, we're looking at the images of the extraordinary engineering of NASA and the Jet Propulsion Lab. This goes back to the heritage of Ranger and Surveyor of a few years back, I'm kidding, many decades ago. And John Farrow, this comes off the Curiosity, which was exceptionally successful, far beyond anybody's fondest hopes. This is Perseverance with 19 cameras, 13 computers, and John, there's a helicopter, much like the surveillance helicopter, to fly within 900 meters or so of the crater they're heading to 7 months out.
Tom, I imagine their helicopter's a little bit different to the one that you dream about, but Tom, you lived this as a child. Space tech and the space race in 2020 is now a state-private combination of partnership. What do you make of that shift, Tom?
It's a very different shift, and it's really going from experiment to experiment. There have been some stumbles. Everybody understands it's needed, and you don't have that immense Cold War catalyst that you had in the 60s. This mission is very much a NASA JPL mission out of California Institute of Technology. They're having the boosters drop off here. Remember, this is not a 3-day flight. 7 months to Mars. John?
From New York City, this is Bloomberg.
I don't know what's happening with the rocket, but right there, a beautiful liftoff. Fun to feel that rumble in the building.
خطوات مكافحة العدوى تكون على أعلى مستوى من تعقيم اليدين بالنسبة للحجاج، لبس الكمامة، التباعد المكاني، التوعية الصحية لهم في الباصات وحتى وصولهم إلى الحجر المؤسسي بمكة المكرمة.
أنا لا أدري كيف أصف هذه المشاعر في قلبي. كما تعرفون أن هذا الركن من أركان الإسلام الحج، واختارنا الله سبحانه وتعالى أن نكون ضيوف الرحمن لهذا العام.
Last year, we took you inside the political turmoil gripping Hong Kong. This year, Beijing tightened its position with a new national security law. Will this jeopardize Hong Kong's position as a global financial center? And will China face the consequences from abroad? I'm Stephen Engel. We take a second look at the crisis facing the city in a Bloomberg television special, Hong Kong on Edge 2.
Been working on the strategic future of the company. We're long past the stockpiling phase now in North America, and what we're seeing is big shifts from category to category. So things like hand hygiene growing very quickly.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Has pretty much done its job. It's gotten rid of the dislocations in the markets, and it's gotten borrowing costs to incredibly low levels. And so there really isn't much more that the Fed can do right now.
If the market is okay with the inflation rate running above 2%, so is the Fed. If the inflation rate goes above 2% and the bond market sells off hard on that news, then the Fed will be forced to change.
Until people really start to feel very comfortable about where we are from a COVID perspective, I think it probably winds up sitting in savings at this point.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, Bloomberg Radio, Bloomberg Television, worldwide, nationwide as well. We welcome all of you. Markets on the move. Price up, yield down, and John Farrow, all of that directs to 29 minutes away with that important claims number.
Just a little sense of risk aversion. Equities lower, bonds bid, the dollar stronger. Everything you expect, Tom, playing out cross-asset worldwide. 8:30 Eastern when the data drops. I've said it before, I'll say it again. For most people, the GDP numbers are for the economic historians. The payroll claims, Tom, the jobless claims, they're for the traders.
It's a high-frequency data, and the high-frequency data, of course, folds into that ugly GDP report. Lisa, what do you see within your reading of the linkage of the American economy into your bond market?
That's what I'm struggling with right now, Tom. I was looking at high-yield bond yields today. That is the yield, the rate that these companies are charged to borrow money. They are the closest to default, and the yield is almost near a record low at about a 0.5 percentage point away from that, less than 5.5%. What's the message from that, Tom? I mean, economically, how do you connect that to anything that's going on with the jobless claims other than just what the Fed is doing to stimulate growth?
Let's go to our It's Out of Times expert, John Farrow. Answer the question. How can you have a default dynamic
let me try and answer the question. Spreads are still 5 percentage points, which are still tight, but nowhere near the tights of the year. So if we're near record low borrowing costs, Tom, it's because Treasury yields are really, really low. And the Fed policy rate is really low as well. And I think you have to bear that in mind. We also have a price-insensitive buyer in the credit market. That's really narrowed spreads as well. So I think when we think about this, away from absolute borrowing costs, which are important to the people issuing the debt, and of course important to the people borrowing and helping them borrow the money, but Tom, it's about spreads at this point, and at 5 percentage points, we're nowhere near the tights of the last 12 months.
Oh, that's a good idea there, and of course you'll hear that on The Real Yield this weekend. What I want to do is say good morning first to Gary Schilling, a guy like Steve Major at HSBC, Jan Loeys in that incredibly important essay on the migration of yields lower a year ago. They have been way out front on that. Someone else, particularly prescient, and we'll get to a discussion of precious metals in China and the rest with Michael Shaul of Market Field Asset Management. He has a wonderful holistic view of what we see in the market. Michael Shaul, what do these low yields signal to you?
Well, there's just a persistent bid at the long end of the long end of the Treasury curve. A lot of economic uncertainty, and I think a lot of bond investors feel that if inflationary pressures started to build and the yield curve started to misbehave, the Fed would do what it could to keep those things under control. So, I think that you have every incentive to maximize duration under those circumstances.
Right, John. I think Michael nailed that right there. The idea here, folks, of a yield analysis where you switch, John, to price, where it's just about people bidding up the paper.
So, Michael, to what you just said, betting against the Fed then is betting for a steeper curve. Would that be right?
Yes, I think that is the case. I think under some circumstances the Fed may allow a steeper curve, but as I say, here is the power of Fed's forward guidance and the sense of what's going to happen. Now, I would add a caveat: if genuine inflationary pressures start to become obvious later this year or early next year, well, then I think you're going to give the bond market a very hard call to make. But if we sort of stay where we are today, the bond market is extremely quiet, and extremely quiet markets tend to stay that way until something changes.
Michael, what does inflationary pressure mean in an era where we see incredible asset price inflation, we see food price inflation, we see home price inflation, but people's salaries are going down?
Well, I think what you need to see is enough inflation in the things measured within CPI to convince people that something is changing. I mean, as I say, I joke that CPI should now be called the COVID price index, because what has happened post-COVID is remarkable deflation in services that people aren't using, transportation and hotels and things like that. But there is real inflation now within the food complex. And I think that is going to spread into logistical inflation later on this year. But after many years of inflation surprising to the downside, I think it's understandable that the market will wait until it's absolutely obvious that COVID has been more inflationary than deflationary.
So,
I
Michael,
do believe that's going to be
speak to what's
the case.
happening in precious metals right now with all of that in mind.
Yeah. Well, I think precious metals are more liquidity and price of money sensitive than inflation sensitive. Inflation arises because money is abundant and priced too cheaply. But what you have right now is precious metals responding to the state of monetary policy globally and the lack of alternatives. I think for gold versus fixed income, and I think we've reached a very, very important point at which it's not just gold going up, but it's the more sort of high beta metals are starting to go up as well. I mean, I said a few weeks ago that the point at which silver started to respond to gold strength and copper started to respond to gold strength would be the point at which you sort of enter a reflationary period. And that's where I think we are right now. So, it's a very long way away from the deflationary pressures that people thought were going to be created by COVID 3 months ago. I think that's simply wrong.
Given the fact that you think that precious metals will continue to have a bid based on what we're seeing with central banks, can we see gold continue to rally in tandem with equities?
Yes, that's my short version. In fact, I'd be more confident of gold going up significantly over the next few months, perhaps, than I would for the S&P 500. I think gold is sort of in that sort of middle of a bull market, kind of where the S&P was when it was marching from 1,500 to 2,000, and people realized that this really was, going to be a historic bull market for the S&P. I don't think it's going to be straight sailing for gold, and obviously not for silver. I think there'll be a lot of volatility. There'll be some pullbacks, but I think this is straightforwardly the most bullish backdrop for precious metals that I have seen since I started following them closely 20 years ago.
Well, 20 years ago, there weren't ETFs. How much of the bid to gold is an inherent and ancient bid to gold versus the new financialization of the bid to gold?
Well, I think ETFs have had a big part to play, but I'd sort of refer you to the bond market where the ETF phenomenon started to build. Bond ETFs were not a factor 10, 12 years ago, and now have a massive amount of bond holdings. And yet, I don't think that negates the sort of genuine nature of the bond market rally over that period of time. So yes, I think ETF ownership is very important for precious metals. It has allowed a different kind of buyer to be long metals. I think a lot of institutions would not want to be long physical gold because of the complexities, but are happy to be long ETFs. But that is just part of the way financial markets work. That is how gold is going to be owned, going forward. And by itself doesn't mean that the march to almost 2,000 lacks validity.
Well, Michael, let's talk about that, because for some people they ask the same question. So let me ask it of you. Yeah. 2020, why is it different to 2011?
Well, in 2011, you didn't have a massive explosion of monetary policy globally. In fact, you were kind of unwinding some of the QE2 in the United States, and the arguments being put forward for gold really relied on the idea that the euro crisis marked the end of the fiat currency, the fiat currency system, and the bull argument wasn't that strong in 2011. Where you are today, you went through a tough bear market between 2011 and 2016 for gold, and silver carried on a couple of years after that. You had a lot of liquidation of positions. And the reasons why people have gone into gold this time around have been different. I think people have been much more patient until the last few weeks, going back into gold. And my sense is that the sort of semi-permanent allocations, in other words, gold has been able to carve out a portion of people's fixed income allocations, which was something we started arguing for a couple of years ago.
Well, Michael, they seem to be more comfortable because of where negative real yields are right now. And I just wonder how comfortable you are with where real yields are at the moment.
I mean, they're remarkably low. I mean, I personally think the bond market is mispriced. If you actually want to look at the value of owning bonds, I think they're a very poor bet right now. I don't think the bond market's about to blow up, because I think people are going to be patient with it. But I think that real yields and even absolute yields argue for owning something else. And gold is the most obvious something else available to you as a fixed income investor.
Michael, great to catch up, sir. Michael Schau there of Marketfield Asset Management on the gold price. And Tom, the relationship between the bond market, the low yields you speak to at the front end, nominally speaking, the nominal yield, get my words out, and the real yields, Tom, deeply negative, really supporting precious metals.
Yeah, we're supporting precious metals. I'll go with that. But are they supporting equities as well, John? I mean, the yield comparison, Howard Ward was brilliant on that this morning with Gabella. He says, we've never seen this gap between even lousy yields or tangible 2% and 3% yields and where we are, dividends rather, and where we are on yields right now. The disparities here are extraordinary.
Oh, Lisa, without a doubt, it's supporting pretty much everything. The amount of people that I've spoken to, and I imagine you have as well, Lisa, who now consider their allocation to investment-grade credit in America as the allocation to treasuries maybe 5-10 years ago, because that's where you get your income. That's where you get your support, because the Fed is in the business.
Stocks are now fixed income. How many people are you talking to who are saying the dividend payments in stocks are preferable to what we're getting in high yield or anywhere else? And so that's where people are going for income. It completely changes the game, John, and I wonder how much that's underpinning the move in equities more than anything else.
Looking at equities right now, Lisa, we're down 28 points on the S&P. We're off by 0.8%. In around about 20 minutes' time, we will get you your economic data in America. US GDP expected to come in deeply negative, perhaps on an annualized basis, the worst print we've ever seen since records started going back to the 1940s. Alongside that, jobless claims in America as well. The improvement has it stalled. The data drops in 20 minutes. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Negotiations resume today on a compromise coronavirus relief plan. The Trump administration and congressional Democrats are nowhere close to an agreement. They're under pressure because millions of Americans will lose their supplemental unemployment insurance this week. White House Chief of Staff Mark Meadows sees little chance for a stopgap measure that would extend those benefits. The number of Americans killed by the coronavirus has now gone over 150,000. Death tolls surged to records in some of the hardest hit states, California, Florida, and Texas. Still, the new wave of infections that began in June appears to have leveled off. Johnson & Johnson is the latest drug maker to start human trials on an experimental coronavirus vaccine. The vaccine protected a group of primates with a single shot in an early study. That's according to a study published in the medical journal Nature. Meanwhile, Germany's economy plunged into a record slump in the second quarter. Output fell 10.1%. That's the most since Germany went to quarterly GDP reports in 1970. Coronavirus restrictions led to declines in exports, consumer spending and investment. Recent indicators signal that growth has returned, but unemployment remains high. AB InBev sold more beer than expected in the second quarter. That's despite the coronavirus lockdown. The parent of Budweiser returned to growth in June after crashing by about one-third earlier in the quarter. AB InBev says investments in digital marketing and e-commerce paid off. And minutes ago, NASA launched its most ambitious Mars rover mission yet. The rover Perseverance will look for signs of ancient life on the red planet that for the first time can be returned to Earth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
In many areas, we're behind our competitors. The most popular messaging service in the US is iMessage. The most popular app for video is YouTube. The fastest growing ads platform is Amazon. The largest ads platform is Google. And for every dollar spent on advertising in the US, less than 10 cents is spent with us.
How to Lose Friends and Alienate People in bookstores everywhere across America by Mark Zuckerberg, coming soon. Tom Keene, unbelievable, straight out the gate, just throwing everybody under the bus.
Yeah, it was, I saw a little bit of it. Full disclosure, I didn't watch every minute of it like Lisa did. But, John, these guys are in their own world, and the haves that have participated with them love it. And everybody else, seriously, Republicans and Democrats are going, say what? I mean, I'm sorry, it's still there.
I agree with you. Let's bring in Aaron Sundararajan, shall we? NYU Stern School of Business professor. Aaron, great to catch up with you, sir. Did anything change in the last 24 hours? Any change whatsoever? Or was that all just a spectacle?
I think the tone of the hearing was very different from any of the past hearings that we've had about big tech. Certainly a little more aggressive, a little more negative, but also from Congress's point of view, much more informed. This wasn't about how do you earn money from your advertising. Many of the members of Congress sort of probe deep into specific issues relating to market power, relating to predatory pricing, that made me feel that they were far better informed than in any hearing that has occurred in the past. Now, there were lots of misconceptions as well, but, overall, I think it's a turning point for big tech regulation, and we've entered a new phase.
Professor, you came out of the Rochester Graduate School Combine, so you've seen personally the collapse of a traditional economy up in Western New York, whether it's Buffalo, Rochester, and you could say that about anywhere else in the country. Your book cover is maybe the most courageous I've seen. The End of Employment and the Rise of Crowd-Based Capitalism. How bad is the end of employment? That's what these politicians were really talking about, wasn't it?
Well, the end of employment is different from the end of work. I think part of the point that I'm making here is that a lot of work that occurs in the future will not come packaged as these full-time jobs that we got used to in the 20th century. But will have a much greater fraction of entrepreneurship. And in many ways, the story that the platforms told yesterday was one of, we are in an economy where you've got millions of sellers on Amazon. You've got tens of millions of small businesses being supported by advertising on Google. If you move away from the big four, there are millions of hosts on Airbnb. There are millions of restaurants delivering through Uber Eats and DoorDash. And so this platform-based economy is going to pervade, our future of work. And, one of the things that was striking to me about yesterday's testimony was this misconception that somehow platforms harm small business. And so while we've seen these sort of local geographic economies implode, it isn't immediately clear to me that small business has been disproportionately hurt by the platforms. In many ways, I think that they're actually shifting a lot of economic activity away from sort of larger to mid-sized players and towards millions of small businesses.
Arun, this is a very important point. Of course, one line of questioning yesterday was the idea that these platforms that do give voice to smaller businesses are rigged, that they're basically in favor of certain companies, namely the platforms themselves and their own proprietary brands. I'm thinking about Amazon. What do you say to that?
Well, I think that was a central theme that came out of the hearing yesterday. And, more broadly, it has to do with, what are the limits that we need to place on channel or marketplace power? I don't think a convincing case was made that the platforms are somehow overtly or explicitly favoring, their own products. Amazon is certainly... Amazon is following in a sort of a long tradition of other retailers in creating store brands. I think a lot of the what happens in the next few months of looking at are they somehow disadvantaging small businesses by looking at a product and then copying it? is the Apple iOS somehow slowing down the performance of competing apps while speeding up their own. You know, because I think broadly, you know, Tim Cook said that it was really hard to sell software before the App Store came along. You needed to sort of get it shrink-wrapped and into a retailer. Now you have millions of tiny app developers who have access to the, you know, the App Store, the Google Play Store. And so prima facie, it's hard to make a case that these things are bad for small business and bad for competition. And the devil is going to be in the details of have they sort of taken specific actions to, like, you know, to crush diapers.com, to, to suppress particular small businesses.
And to your point, Jeff Bezos yesterday coming out and saying, unlike industries that are winner-take-all, there's room in retail for many winners. I'm wondering, Arun, we're going to be getting earnings from Apple, Amazon, and Alphabet after the bell today. Are you looking for some sort of self-regulatory measures that will crimp their profitability to get ahead of any potential regulation from Washington?
Absolutely. I think a lot of the purpose of hearings like this is to create a credible threat of regulation if the platforms don't do something themselves. But because, you know, if you think about what society has done, we have given these platforms a tremendous amount of power. Government-like power, with censorship, with ID systems, with copyright and intellectual property. Facebook is backing its own currency, surveillance. And so we can't sort of suddenly say now, hey, I mean, like, you know, we're unhappy with the status quo, and we're going to come in with a big stick and make you change your behavior, because that, I mean, like, you know, no nation-state government actually has the power to do that. And the real solution is going to be self-regulatory. But I think the platforms are being nudged in the right direction to make changes by the specter of, like, you know, big government regulation. And to me, the best solution for society is for the platforms to take matters into their own hands and say, well, here are the changes we're going to make. Here are the limits we're going to place on the power that a marketplace creator has in developing, in being a supplier. Here are the limits we're going to place on predatory pricing. Here are the limits we're going to place on privacy. And so because they are better informed than any government entity about, like, you know, what's possible. They're closest to the action, and so I think that's the future we're going to see unfold in the next 2 or 3 years.
Arun, we're lucky to have you on the show today. We appreciate your time. Thank you, sir. Arun Sundararajan of NYU Stern School of Business. We are 5 minutes away, Tom Keene, from the scores on one of the worst quarterly GDP numbers we are ever going to see in this country.
You know, we're here, unless for those of you on radio and television that partition this, there's the 1 week claim, John. There's continuing claims, and then there's also something I look at the 4 week moving average of that 1 week statistic.
Claims set to tick a little bit higher. Second quarter GDP set to come in at negative 34.5%. That's the estimate. The print is next from New York with futures down 26. We're off by 0.8%. This is Bloomberg Surveillance.
true diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
The fees that retailers had to pay to be able to enter the markets, the democratization of the markets by allowing them to have direct access to the markets over the last 10 to 20 years has really been, a key trend that has driven, I would say, the U.S. markets.
From New York City, for our audience worldwide, this is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. The economic data from an ugly second quarter dropping across the Bloomberg terminal any moment alongside jobless claims. Let's get to the claims first. Here's Michael McKee.
Well, John, the questions today are how bad was it? How bad is it going to be? And it looks like it is going to be bad. We see an increase in jobless claims, 1,434,000. That's an increase. Let me just check the number here of on the month increase of 12,000. So we do see an increase in jobless claims during the month. The total number of people who are getting jobless benefits falls to 30,202,000. If you consider that good news, that 30 million people still have claim on some sort of unemployment benefits for the United States. Okay, how bad was it? Well, here's the GDP number. The first number that we have out on an annualized basis, GDP falls 32.9%. Gee, that's better than we anticipated. It was forecast, the consensus was for a negative 34.5% drop. Now, I can tell you this is the worst number ever by magnitudes. The worst we ever saw in a quarter was negative 1.9%, and that was in 2008 and in 1949. So a really, really terrible number on GDP. We're waiting for the rest of the GDP breakdown to drop because it all comes across live. But we can tell you that personal consumption, consumer spending down 34.6% on the month. The GDP price index down 1.8%. Core PCE down 1.1%. These are quarterly numbers, so the Fed doesn't pay as much attention to them. We'll get the income and spending numbers for June in tomorrow morning, and that will tell us much more about where inflation is. So we're waiting for the GDP numbers to come out. I'm looking at the number here, and we still have only the first quarter numbers up on the Commerce Department release, so we're still waiting for a breakdown.
Well, that's okay, Mike. Let's just get on a data point that I think is really worrying. Continuing claims. Michael McKee, that's up a mil.
Yeah.
That is dreadful.
17,018,000. It just shows you that what we're seeing now is people going back onto the continuing claims rolls, people who may have gotten jobs back. Restaurants may have reopened, and then all the governors had to close them again, and so people are back to getting more jobless claims. And remember, that number is delayed a week. That's a week older than the current claims number.
Mike, you were on the back end of the Zoom press conference yesterday with the chairman, and you nailed it off the x-axis in the longer delicacies. You were asking the chairman. These numbers agree with what you thrust yesterday, which is we're reframing lower for longer. How far out is Mike McKee? 22, 23, 2030? Where are you, Mike?
You know, I think that's a hard question to answer. The Fed is out to the end of 2022 at this point, but I think Jay Powell and the Fed put it best when they said the virus is in control. If we were to get a very quick vaccine out there sometime in 2021, and then people felt confident and went back to spending, you could see the economy snap back much more quickly, and then the Fed would have to react to the possibility of inflation and faster growth. So we'll see what happens going forward. That's part of the problem for the Fed. They're in this weightless environment where they really don't know what's going to happen, and there are so many different possibilities.
One reason why you're so good, Mike, is because you can look at the headline numbers and you can look at the figures and dig under and speak to the churn under these employment figures. Do you have a sense of what the big contributor was to the increase in continuing claims? Is this a result of people who are employed, not employed, employed, and then refired as the close downs were re-engaged, or is this a result from permanent layoffs at big companies?
Well, it's probably a mixture, Lisa, of all of that, because a lot of people, as we said, went back to work and maybe then got kicked out again. We're seeing more and more companies start to close up permanently. Of the number of companies that are closed, Yelp keeps track of companies that are closed. They said 55% of those who report being closed are now closed permanently.
John, ask a long Tom Keene question here so McKee can look at the statistical summary that just came out.
Well, I think the way I'll frame it, Tom, and I'll talk slowly and give Michael McKee a chance. I think the payrolls report in a week's time is the most unpredictable payrolls report we have had in quite a while. Yeah. Michael McKee in just a moment is going to speak to the survey week, but Mike, I imagine a lot of people are looking at that continuing claims number and wondering what estimate to put in next week. Could we get a negative print for the month of July?
Sure we could, and there are some people who think we're going to get it. It's going to be very important next week to look at all of the other indicators that we get, including the ISM numbers, and we'll see what they say about hiring, and we'll see what the ADP number says, and people are going to just try to construct something from this. But as Jay Powell said, the numbers on employment in small companies, the home-based numbers that the Fed has been looking at, have gone down over the course of July. One number in the early part of the month showed 4.1 million people losing jobs. We don't know how many people got jobs to offset that, but it does suggest that there is a possibility for a negative number.
And 10-year yield coming into 4 digits, 0.5495. So clearly some nuance here. 30-year bond at a 1.2000 exact. Mike McKee, thank you so much for always the wisdom, and particularly the effort at the press conference yesterday. I'm going to read you some numbers, folks, about what was as we bring in David Kelly of J.P. Morgan. And David Kelly knows these numbers, and he knows why I'm going to them. The animal spirit line of nominal GDP, long ago and far away, 4%. A better number, 4.1. Back to 4%, 3.9%. Then it was terrible, negative 3.4%. And the new statistic, David Kelly, negative 34.3% nominal GDP. That is unsustainable. What gets us out of this besides a cure of the virus? David, is there a policy prescription that can lessen this pain?
Well, yes, you can lessen the pain by doing two things. One, you've got to make sure you don't have more layoffs at state and local governments. If you look at the aftermath of the great financial crisis, we had 5 years of job losses at state and local governments because they couldn't balance the books without laying off workers, given the state of the economy. So you need some, if you're going to spend federal money by giving it to state and local governments so they don't have to lay off workers who can work during a pandemic. Second, you've got to get this unemployment, this $600 right. $600 is too much because for a lot of low-wage workers, it actually makes it, they're losing money by working. But zero is the wrong number too. So I think a settlement on something like $300, which will give people just enough of incentive to get back to work while still avoiding widespread poverty. Those are the two things the government could do right now to try and alleviate the situation. But you're completely right. The number one thing you've got to do is you've got to control the virus. I remember many years ago, Mickey Cantor said, it's the economy, stupid. Well, now it's the virus, stupid. You've got to control this virus if you want a full reopening. So we're going to get a bounce in GDP in the third quarter, but this is not a V-shaped recovery. This is a V interrupted, and it's being interrupted by the growth of this pandemic. We've got to get that under control.
David, when are we going to actually see the true pain of the unemployment figures that we're getting right now in consumption, in sort of the bleed through to default, in some of the economic pain that's been forestalled by the enhanced unemployment benefits and some other fiscal measures?
Well, of course, if we don't get another package, we'll see it pretty quickly. But I think we will continue to see, over the second half of this year, we're going to see more traditional recessionary indications of, more bankruptcies. Companies are sort of held in there because the PPP are going to unfortunately go bankrupt. So we're going to see a lot of that. Hopefully you can have a phased reopening of the economy and some more federal money to try and alleviate things. But unfortunately, policy is not really designed to protect the equity of small business owners here. And I think that's, to me, that's one of the biggest tragedies here. The people who've put a lifetime into building a small business, and they're just going to get wiped out by this thing, and the government really isn't finding a way to help them. So there's a lot of pain to come. We will, though, we'll get a vaccine in 2021. I think we'll get multiple vaccines. So at some stage when we all pull together and decide as a nation that we are going to rid ourselves of this virus with the help of a vaccine, then we'll get back to normal. But we do have to wait for that.
David, I think we all fully understand the reaction function of the Federal Reserve. What I don't quite understand right now is the reaction function of investors. How do you think investors respond next week if we get a negative payrolls print?
Well, you may say you'll probably see some sell-off in the equity markets because that won't necessarily encourage. There's not much more that I think Congress is going to do. So if we got that print, that'd be right. But on that print, if you go back 5 weeks ago and look at the unemployment claims for the survey week in June, and then you compare it with the survey week for July, we still got about a 2 million person reduction in continuing claims. So I still think we might get a small positive on payrolls for the month of July, and then a negative one for August. But the broad picture is, I don't think the labor market's going to get much worse, but it's not going to get much better. I think we'll still have over 10% unemployment as we go into 2021.
David Kelly, great to catch up with you, sir. JP Morgan Asset Management Chief Global Strategist. Our best to the team at JP Morgan. Mike McKee just giving us a little bit more colour, Tom Keene, on this GDP print. You and I, about 90 minutes ago, talked about the annualised approach here in the United States. On an annualised basis, we're down about 33% for the second quarter. Non-annualised, it means the economy contracted 10%. So if you want the apples-to-apples comparison, Tom, just to compare that to Germany, also negative 10%. It's a big, big contraction for this economy. This concept that it's a V interrupted, maybe some people think it's worse than that, Tom, that this is the V, the right wing of the V, rolling over into a much, much shallower recovery. And there's some evidence of that in this jobs market in the last 2 weeks.
I don't like the letter soup thing. I just don't like it too, I don't like the game,
I hate it too.
But what we can say without question, and it's only July, the V is absolutely evaporated.
And Lisa, I've got to say, payrolls next week, we are going to hear a lot more about the possibility, the probability of a negative print for the month of July.
You asked the key question, what's going to be the market response? I don't understand. Everyone's saying it's the virus. Everyone's saying it's the employment figures, and yet that doesn't seem to phase markets with everything going up. I mean, today we're seeing a little bit of risk off in tech, although this arguably could have more to do with the earnings than anything else. This is the struggle here, the divorce between market response as well as the fundamental data that we're getting out. It looks pretty bleak.
Well, the GDP data is terrible, but I really, really hope down in Washington today the focus is on the recent numbers, the claims, because they'll say they've already responded to the ugliness of the second quarter. They need to respond to what is happening right now, Tom. And that's this recovery stalling, slowing down.
I mean, Dr. Kelly had the compromise number there. I mean, I don't know what the appropriate number is for paycheck, and everybody's got their own political view. But you got 600 down to 0, and Dr. Kelly said, find a midpoint. There's got to be a lot of those conversations in Washington, John, or millions of people get crushed.
Pressure's on ahead of the payrolls report for Washington next week, that's for sure. In your market right now, equity futures down 26, off by 0.8%. Up next, conversation you do not want to miss. Raghuram Rajan from the Group of 30 Working Group and the former RBI governor from New York City. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Trump administration and congressional Democrats are no closer to a compromise on a virus relief plan. The pressure to act is building. Enhanced unemployment insurance for millions of Americans is running out this week. White House Chief of Staff Mark Meadows sees little chance of a stopgap deal that would cover only those jobless benefits. There's an agreement for federal agents to leave Portland, Oregon. There's a disagreement about when. Oregon's Governor Kate Brown says the agents will begin leaving today, but acting Homeland Security Chief Chad Wolf says there will be no pullout until it's clear that local law enforcement can prevent violence at the federal courthouse. That's been the target of angry protesters. Supreme Court Justice Ruth Bader Ginsburg is in a New York City hospital. She's undergone what's called a minimally invasive procedure to address an issue with a stent in a bile duct. Ginsburg is 87. She was hospitalized earlier this month to clean out the stent. Ginsburg recently disclosed she was diagnosed with a 5th bout of cancer. In Hong Kong, the government has barred 12 pro-democracy activists from running in the upcoming Legislative Council elections. It says they didn't comply with requirements. One of those is support for national security law passed last month. The move came hours after Hong Kong police arrested 4 student activists for making online comments that allegedly violated that law. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 100 countries. I'm Ritika Gupta. This is Bloomberg.
Has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The path of the economy is going to depend to a very high extent on the course of the virus and on the measures that we take to keep it in check. The data are pointing to a slowing in the pace of the recovery. But I want to stress, it's too early to say both how large that is and how sustained it will be.
Well, we're getting a little bit more color on how much that economy is slowing down this morning. From New York City, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, it's a moment to get the really sensible, deep thinkers on the program and think about what is happening to this economy. In just a moment, I'll be catching up with Mohamed El-Arian, Allianz's chief economic advisor and Bloomberg opinion columnist.
Well, the conversation is what we live for. It's great to have Dr. El-Arian with us. I heard from him this morning as well. He was absolutely dazzled at how the Red Sox have started slow, John, I believe is the word that Dr. El-Arian used. Driving forward the conversation right now for us as we spoke with Kenneth Rogoff this morning of Harvard University on an important Group of 30 study of digital currencies. We're going to touch on that quickly here with Raghuram Rajan of Chicago, Group of 30 Working Group co-chair, former Indian governor, RBI governor of their central bank as well. Raghu, wonderful to have you with us today. What is the distinction of your study? What does this drive forward about how technology is changing money?
Well, this is the digital currencies are a revolution, right? For the first time in 300 years, we can replace cash with something digital. Now, we've already replaced bank accounts. We have digital bank accounts, but think of everything going digital and what possibilities that creates, but also what challenges if, for example, the government issues this digital currency, the amount of data it's going to collect, the amount of privacy it's going to violate, and what concerns that raises. Those are what are made possible by these new technologies, cryptocurrencies, government digital currencies. That's what this report is about.
When we talk about digital currencies, it's one aspect to talk about technology and just creating a digital form of what we already have. It's another to say we're debasing the existing currencies. Let's come up with an alternative that could preserve its value in tandem with gold. Which side are you on as the most plausible for the future of digital currencies?
Well, it's the first. I think this idea of a private cryptocurrency, which is forever going to maintain its value, is interesting. But, credible central banks have done that with fiat currencies. So really the issue is once we convert that the cash, the stuff that you have in your wallets, into something digital, what new possibilities arise and what new challenges? How do we contain all the concerns that emerge from that? And that's really what this is about.
Dr. Rajan, I must bring this up. For the first time ever, folks, in all my years, I have taken a book of the summer of a year ago and made it a book of the summer of the following summer. I've never done that before, and I do that with Raghuram Rajan's The Third Pillar, which is a primal scream for community in America, community in other societies. I want to talk about how the third pillar matters, Raghu, and I want to talk about what you've observed over the last 3 months or so and how we need to get away from our culture wars back to community.
Absolutely. I mean, actually, take the example of fighting the coronavirus, right? The countries that have been very successful at it, South Korea, Germany, typically have had a combination of a centralized approach, setting broad parameters, getting the funding, but also a decentralized approach where each region figures out what its issues are, how it deals with it specifically, and how it brings its resources to bear. And so my sense is there is a broader example here that, in fact, the way we're going to move ahead in our diverse countries without upsetting each faction is to have a coherent, capable central government, of course, but also decentralized processes.
If we look at the fault lines of the market right now, Dr. Rajan, I'm seeing yields come in. Folks, I'm not even going to do the data check here just to save time. Is the market telling the Fed what to do? Can the market drive us towards negative interest rates?
I think the Fed is resistant, and my sense is ultimately moving us negative. It will be the Fed which will move us. I don't think it's the market. However, to some extent, I think it's the real activity on the ground which is moving the Fed, and the real activity is driven by this huge unknown, as you well know, the coronavirus and how we deal with it. I mean, everybody is very sanguine about a vaccine coming soon, and of course, that's going to take time. And it's going to take time to roll out. So there are tremendous uncertainties. The Fed is going to be as supportive as possible. I don't think that support right now extends to going seriously negative.
Raghu, how concerning is it to you that the Fed's policies are propping up people who own stocks, typically the wealthier individuals, and not necessarily giving that much back to Main Street? And this is just by function of the Fed's design. How concerning is that at a time when we don't have a fiscal plan yet in Washington?
Well, you do obviously need a fiscal plan, but I think the support, certainly for Main Street, is structured there. Whether firms can take it is an issue. There is an additional issue, which is at what point does the Fed allow the market to start resolving firms? In other words, if this continues for some time, there will be a number of unviable firms. At what point does the Fed say, we're not going to support as much as we can, we're going to withdraw some of that support so that the unviable firms can be put out of their misery, which will actually create space for the remaining firms and make them healthier. So that issue has to be tackled eventually. I don't think now's the time, but the Fed will have to start thinking about that the longer the pandemic sort of lasts.
Professor Rajan, thank you so much. With the Booth School of Chicago, and of course, Group of 30 working group co-chairman of an important essay with Ken Rogoff on digital currencies, Raghu Rajan. Lisa, the bond check, futures negative 36. Lisa, look at the curve, 0.1172, 2-year, 0.54. 10-year, 30-year bond well under 1.20%. These are markets on the move, Lisa.
I think it's really important to say 10-year yields are just within fractions of basis points within new record lows as we look toward a weaker economy given the surge in virus. Meanwhile, we also have political risk coming back. President Trump tweeting perhaps we should delay the vote, coming out and saying that it will be a great embarrassment to the U.S. if mail-in voting is peppered with inaccuracies and fraud. And he's saying, delay the election until people can properly, securely, and safely vote, question mark, question mark, question mark. Tom, not a big move in markets. A question, though, how this is going to be priced in as we get closer to November.
There's no question. That's been floating around in the zeitgeist, to say the least, and there it is from the president as well. There's much more coming up. Dr. Alarian here in moments on Bloomberg Television. Paul Sweeney and I will really take a look at the technology view on Bloomberg Radio. Janet Henry with HSBC. Look for her later on Bloomberg TV. Futures at negative 35. The VIX out two big figures, 26.30. This is Bloomberg Radio. This is Bloomberg Television.
It's humbling and it's incredibly exciting in terms of anything that we've done, so far as a company. Florence isn't trying to trick you that she's a real person. You know, Florence is saying, I'm a digital person, I'm here to help. Florence is digital, there is no judgment involved. So the lack of human judgment actually makes, you know, our digital people more approachable and potentially more helpful.
Last year, we took you inside the political turmoil gripping Hong Kong. This year, Beijing tightened its position with a new national security law. Will this jeopardize Hong Kong's position as a global financial center? And will China face the consequences from abroad? I'm Stephen Engel. We take a second look at the crisis facing the city in a Bloomberg television special, Hong Kong on Edge 2.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City, for our viewers worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell this morning. Good morning. Equity futures down by around about 1.2%, a 10-year yield on a closing basis sitting at record lows. Let's begin with the big issue. We're nowhere close. The words of White House Chief of Staff Mark Meadows heading into another day of talks on Capitol Hill. Senate Minority Leader Chuck Schumer lashing out.
They're tied in a total knot because of the disunity in their caucus, because of their inability to gather votes, because the president says one thing one day and says another thing the other day. We want to come back and keep talking to them, but they don't have anything to say.
Senate Majority Leader Mitch McConnell remaining hopeful, saying the following: many things around here happen in the last minute. Hope springs eternal that we'll reach some kind of agreement, either on a broad basis or a more narrow one, to avoid having an adverse impact on unemployment. Joining us now is Kevin Cirilli, Bloomberg Chief Washington correspondent. Kevin Cirilli, does the data of 30 minutes ago sharpen the minds down in Washington?
I don't think it has any choice but to sharpen those minds, especially now as lawmakers are continuing to race against the clock to get to some type of deal that could come a major breakthrough either later this afternoon or tomorrow, I'm told. Let's pull up some of the sticking points that are happening between Republicans and Democrats, including over the unemployment benefits that are set to expire just tomorrow evening. Beyond that, I think that there are other sticking points as it relates to Republicans demanding liability protections for businesses and Democrats wanting protections for workers. Democrats also want to see $1 trillion for state and local governments alone. They feel that if they don't get that fund to bail out the states, to bail out local municipalities, that there could be furloughs and job losses at the state level. Republicans are saying, why should they be on the hook to do that? So some major disagreements that have emerged over that price tag, Jonathan, but we're still, again, I'm told there could be some breakthrough by the end of the week, especially in terms of a kicking the can down the road approach or a piecemeal strategy.
Kevin, it's the art of distraction with this president, and he's always fantastic at leading the media to where he wants them to go. 30 minutes ago, we had some dreadful claims numbers, continuing claims up almost 1 million. It speaks to an economy that's stalling. The president in the last 30 minutes is not tweeting about that. There will be no little run around the ring about how good the jobs numbers are this morning. It's a tweet about delaying the election until people can properly, securely, and safely vote. Is there a coincidence at play here, Kevin, as you see things playing out? The numbers 30 minutes ago, ugly, and now the president in the art of distraction?
I think it's a great point that you were to raise, and I had to brush up on my constitutional history before coming on here, because Could they delay this election? I mean, you would have to go back to 1845. That's the last time that the election laws were set in this country. And even if lawmakers were to change and move the date of the November 3rd election, then they would have to they'd have to change the Constitution in terms of whether or not they'd want to change the swearing-in date or the inauguration date. That's set by the Constitution. So talk about a legal fight. They've been talking about mail-in voting, you know, and whether it's Stacey Abrams or Governor Larry Hogan. I mean, yeah, this is a partisan fight and one that the president, clearly based upon his tweets, wants to have.
We'll focus on the economic data. Kevin, great to catch up with you, sir. The words of Mohammed Al-Arian of Allianz and Bloomberg Opinion reacting to the latest economic data, tweeting the following. Q1 GDP fell by 32.9% annualized, a record contraction that, like too many other data points before it, will force a recasting of y-axes, and jobless claims rose to 1.43 million, pointing to the leveling off of the recovery and the higher downward risk. Mohammed joins us now. Mohammed, it's fantastic to catch up with you, sir, and I appreciate you getting up early in the morning for us on the West Coast. I always do. You and I talked last time about whether there is evidence of this economy rolling over, going backwards, or just flattening out. A week ago, you said no evidence of reversal. What about this morning?
No, I think, John, we're stalling. And let me explain what I mean by that. We had a very big hit in the first quarter, and the 32.9 record contraction in GDP is yet another confirmation of what a big blow the global economy took. What we're getting now is evidence that the recovery is leveling off. So yes, we went up in jobless claims, but not by that much. Yes, we went up in continuing claim, but it's more of a leveling off process. But if, and I want to stress, if we don't get fiscal action, then we will go backwards.
Mohammed, it takes us towards possibly one of the most unpredictable jobs numbers coming up next Friday in the United States of America. Do you think there's a real chance of a negative print on payrolls for the month of July?
I do, but I'm a little bit hesitant in saying that's what's going to happen. I think actually it's probable. And the reason why it's probable is because people are being laid off, as we saw. But remember, this is really noisy data, and there's lots of moving pieces. So it is possible. I would say it's even probable. But let's look at the trend rather than a single data point.
Well, hopefully the trend doesn't go that way. But Mohammed, in the meantime, the market's going to move. And something I'm trying to understand, Mohammed, is how investors and market participants respond to the incoming data, the reaction function of individuals looking at this data coming through and what they do in this market. If we got a negative print next week, how would you expect this market to respond?
Look, John, you've heard me say from day one, the conditioning of this market is so deep and is being reinforced by everything we hear from the Fed, including yesterday. I heard Chairman Powell yesterday use 3 levels to stress that interest rates aren't going up anytime soon. He said, we're not thinking about not thinking about not thinking, right? He went 3 levels in to stress that monetary policy would be incredibly supportive. So you need a really big shock. I don't think economic data does it. What I think does it, and you've heard me say that, is capital impairment, defaults. And I fear that that defaults are going to be going up. So the question is going to be, at what point do you reach a critical mass of capital impairments for people to realize that only certain assets are directly under the umbrella of the Federal Reserve?
When do you expect to face that challenge this year, Mohammed?
You know, timing is really hard because the conditioning is so deep. But I suspect in the next few months, we are going to see default rates that are going to be a wake-up call to markets. I hope we don't see it, John, but on current trends, if we don't get the health situation under control, that's what you're going to see in the U.S. And unfortunately, that's what you're going to see in some emerging economies as well.
You said there were areas of this market that would be at risk. Which ones?
So it's anything that's outside the umbrella of the Fed. Remember, the Fed is buying certain assets. And if you are holders of those assets, you're reassured. You have behind you a non-commercial, not price-sensitive, so a non-commercial buyer with an infinite balance sheet. That is very comforting. If you're a holder of investment-grade bonds, that's very comforting. If you're holders of government bonds, that's very comforting. Look at what's happening to the Treasury market today. If, however, you're outside the umbrella and you're just benefiting from the indirect effects, then you are at risk. And I don't think people quite realize how at risk they are right now.
I wonder how EM fits into this, and congratulations on the new role as the chairman over at Gramercy, Mohammed, EM specialist. So walk me through how you guys over there are thinking about things in emerging markets too.
So Robert Godesberger, the founder, stresses the barbelled approach. You want to be barbelled right now. You want to be secure under an umbrella, and for emerging economies, that is highly collateralized portfolio positioning. And on the other side, you want to wait. You want to wait until the markets overshoot, because that's what happens in markets that are inherently liquid, and then get in. But be careful of the belly of the curve. That's a very crowded trade right now in emerging markets, as it is, by the way, in high yield and in equities.
Mohammed, you've been conservative through the rebound. You've talked about that and reflected on it with me a few times already, that perhaps you were too conservative. But at this point, if you had to restart, how much would you allocate to cash at the moment?
So I've been wrong. I've been too careful in the last 3.5 weeks. I rode the wave, focusing on names that were underpinned by very strong balance sheets. You and I have talked about them. They did extremely well. I thought valuations had gone too far. They've gone even further. So I didn't respect the technicals as much as I should have. Right now, I am just happy for my tactical exposure sitting in cash. I worry about valuation, Johns, but I stress I've been wrong for the last few weeks. But I do worry right now about valuations, given the economic and corporate backdrop.
Mohammed, you're always open and transparent about when you're right and wrong, but I also wonder if you could just give us a little bit more clarity on what would make you become more constructive and put that cash to work outside of a pullback in this market. What would make you capitulate?
What would make me say, look, now I should go in at these valuations is indications that we are truly in a V scenario. That is what would make me go back. Because if we are in a V scenario, then you minimize the longer term cost to the economy and to companies. I worry about short-term problems becoming longer-term problems. And what we saw today is two things. The short-term problems were big. That's what the Q1 GDP number told you. And the second thing we saw from the jobless claims data is that we are not dealing with the short-term problems. So the chance of them becoming long-term problems has increased. I need to see evidence that that's not the case before I go back into this market.
Mohammed, we're lucky to have you on the show this morning. My best to the family and to you. Mohammed El-Erian there on this market, on this global economy. Coming up on this program, Fed Chair Jay Powell remaining accommodative and calling on Congress to do a whole lot more. We'll get the outlook from Mike Schumacher of Wells Fargo next. In this market right now, 20 minutes away from the opening bell, just off session lows, down 37 on the S&P. We're negative a little more than 1%. A 10-year Treasury yield on a closing basis, sitting in and around all-time lows. From New York City, this is Bloomberg.
you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Other tools such as income tax would require a lot of time to prepare, because if you don't have the base, this will take time. So whatever we are thinking about, we think also about implementation and ease of implementation.
Fiscal policy is essential here. Direct fiscal support, fiscal policy actions, there will be a need, both for more support from us and from more fiscal policy. We are committed to using our full range of tools, fostering more accommodative financial conditions.
Fiscal, more accommodative. You get the picture. Fed Chair Jay Powell reiterating his pledge to prop up the economy, emphasizing the downturn would be the most severe in our lifetime. Michael McKee, back with us, Bloomberg International Economics and Policy Correspondent. Mike, the chairman was reluctant to say the degree to which he thought this recovery had slowed down. Do you think if he'd seen the data this morning, he'd change his mind?
Not really, because the data that tell us what's happened in July with the jobless claims, and he did mention those yesterday, and the idea that things have slowed down in July. We all knew that the economy was in terrible shape in the second quarter, and the numbers today validated that. The question is what happens next, and that's where the Fed is kind of at sea. And, you know, you asked Jay Powell, as I did, what can you do? And the answer is not really a lot. He didn't have a good answer to that because the Fed, their tool is interest rates, and interest rates are already on the short end at zero. Now, you pull up the yield curve, you can look at the longer end, and it is a steep yield curve, and the longer end could come down more if the Fed does QE or yield curve control or something like that. But with the 10-year at 54 basis points now and the 30-year just over 1%, there isn't a lot of room to move anyway. And you look at mortgage rates, they're at historic lows, so what kind of bang for the buck are you going to get out of that? The one thing they could do is maybe tie forward guidance to some sort of state of the economy. We've talked about this before. Once they put out their monetary policy review, they may tie it to the average, change their 2% goal to an average of 2%, allowing for an overshoot. Now, I got a chart, if we can pull that up here, that shows what's happened to the inflation rate over the years as the Fed has acted. When the Fed is calling did 7 years of 0% rates during the great financial crisis, they couldn't get to 2%. And the last time they traded higher inflation for lower jobless numbers was in the 1970s, and we remember what happened to inflation then. So there's no guarantee that even forward guidance is going to get something done for the Fed, and it leaves Jay Powell in a tough situation. Not much the Fed can do except keep saying fiscal help, fiscal help, fiscal help.
What was the other message? See you in September, Mike. Do you think we actually will get a decision on forward guidance this September?
Probably. He talked about the monetary policy review being finished very soon, and that could be what sets the stage for the September 16th meeting when they come out and they change the forward guidance. But again, a lot may depend on the progress of the virus and the progress of the economy at that point.
Michael McKee on the latest from the Fed. I want to check in on the market for you. 14 minutes away from the opening bell in New York City. Equity futures down 36, down a little more than 1% on the S&P 500. If you get to the bond market, you can see the bid yields in 3 basis points on a 10-year, just below 54 basis points. On a closing basis, we are right there on the ding-dong lows of all-time record lows for a US 10-year. On a closing basis, still some way off. So we've got all-time lows on a closing basis on a US 10-year, record lows on a UK 10-year. You see the direction of travel for the bond market. Yields lower as central banks tell us, rates lower for a whole lot longer. Here's the Wells Fargo take on the Fed decision. They write the following. Chair Powell left the door open for additional measures. We think forward guidance is likely in either September or November, with an adjustment to the inflation targeting regime also possible. Mike Schumacher joins us now. Mike, great to catch up with you, sir. Let's start right there on forward guidance. What are you looking for this September?
Look, I think it's interesting. I think Mike McKee framed it well, John. The Fed probably announces something, and it's thrown out a couple of alternatives. Does it talk about doing the Australian approach? So really having forward guidance and trying to link that to yield curve control in some shape or form? Is it forward guidance with respect to a particular economic data point. We think it's more likely to be the case. The Fed talks about keeping yields low for an exceptionally long period of time, but we look at it and say, how is that really all that different from what the Fed is doing currently? You've got rock bottom Treasury yields, as you just mentioned. Seems like the market's behaving pretty well the way the Fed wants it to as far as Treasuries. So what does it really gain by additional guidance? And I think the response is the Fed will be able to go through life and not expand the balance sheet as rapidly. Well, that's nice, and maybe that's a political plus, but that's about all it really picks up as far as we're concerned. Still, doesn't matter so much what we think. We think the Fed is still likely to go down that path, and it's what Jay Powell and his crew want to do.
They tied themselves to a threshold before. You think they'll do it again, Mike?
Probably not a complete link. So it's challenging because the Fed's got really a broad-based mandate. So does it pick one or two or three economic data points? And what if they conflict in direction? How does that work? So could it really just anchor it to the unemployment rate? That's probably not the right approach. I think it's pretty challenging simply to pick one data item and say, this is it. We'll hang our hat on that one.
What's really difficult, I think, for people in the bond market is to know what to do at the long end right now, Mike. Front end, of course, is the elephant sitting on the curve, and it is the Federal Reserve. Longer end, Mike, I think this is where people get a little bit confused on what to do. What do you do at the longer end of the yield curve in America when the Federal Reserve may well step in an aggressive way with yield curve control in the coming months? Mike, you may well think that Treasury yields can go higher. The Fed may want to do something else. So how do you make that adjustment in your own mind? How do you make that calculation?
Well, it's a risk like anything else, but I think you've got to ask yourself, if you're an investor, if I'm buying the 10-year Treasury at 55 basis points, what's my upside really? Does it go to 50 or 45 or, heaven forbid, 40 maybe? Does it go much lower than that? Probably not. So it seems to us the classic case of picking up a nickel or dime in front of a steamroller. Now, you might be right to a small degree, but you could be awfully wrong. Let's flip it around and talk about the V, whether it's a V-shaped economic recovery or perhaps V as in vaccine, then what? Yields explode upward. So you can see an increase in yields of 50, 75 basis points pretty quickly in the case of a credible vaccine, whereas maybe if you're right and yields fall, they drop 10 or 15 basis points. That asymmetry seems like a pretty bad play to us.
So, Mike, when it comes to this bond market right now, if I ask an economist the balance of risk, they'll say they're tilted to the downside. Are you saying they're more balanced than most people realize?
I think that's fair. And look at the pressure globally to try and develop vaccines quickly. I'm certainly not going to weigh in as far as the progress there. It's not my area of expertise, but there's an enormous volume of resources at work. And with respect to trying to keep the economy chugging along, you've seen the fiscal response in the U.S. pretty strong so far, as Mr. Powell said yesterday, stuttering a bit over the last week or so. I guess that's what happens when you try to get a flamingo to mate with a giraffe. But nonetheless, perhaps there's a decent chance still of Congress coming up with a bill that works over the next week or so. So the fiscal response is really to try and keep things moving until there's progress on the vaccine. And we think that's a comparatively balanced case. Yes, if the COVID situation worsens dramatically here in the U.S., you'll see an economic downtick that's almost inevitable in that situation. But how much worse does that get? Probably not a ton over the next month or two.
Mike, continuing claims this morning, up 1 million. There's a real chance for a negative jobs print next month. I asked this question of Mohammed, so let me ask it of you. Is this a recovery flattening out or starting to go backwards in reverse a little bit?
It's probably flattening out at that point. And with respect to the market reaction, I think that's pretty clearly risk off. Now, does it mean that equities go down 5 or 10%? That seems far-fetched. But risk assets have had a tremendous run. We would look at that and say it's a risk-off event.
The length of time below potential growth has got to do something to the future for potential growth. That was something that Mohammed's talked about in this program before. Mike, do you appreciate that if we don't recover quickly, the scarring is going to emerge in a material way?
Yes, and I would frame it perhaps slightly differently and think about the decay in job skills or employment skills of people who are out of work for 6 months, 12 months, longer perhaps. They become a lot less current. They're not as up to date. They're not as really as able to step in as they once had been. So I think that's the risk. And Jay Powell's talked about this quite a bit, frankly, and that's really the downside of having really high unemployment for a lengthy period of time. We want to try to get that down quickly.
Mike, great to catch up with you, sir. Mike Schumacher there of Wells Fargo on this bond market, this economy as well. Coming up next Friday, the jobs report. The estimate right now, positive 1.875 million. Let's check in with that estimate this coming Monday to see how things develop. The range, I imagine, is going to be really wide. Coming up on this program, we'll get the view from Capitol Hill to Wall Street. Big Tech reporting results after the closing bell. Jefferies analyst Brent Thill joining us at the opening bell very shortly from New York. This is Bloomberg.
As it stands right now, we are seeing too many people, for whatever reason, attending work with symptoms. That just cannot continue. Otherwise, these restrictions will be in place for longer than they should be. And I'm sorry to say, we will see more people die.
When community transmission takes place, it is inevitable that it will find its way into the more vulnerable parts of our community, and the aged care community is certainly one of those.
Certainly, these are very challenging numbers. We're at a very challenging stage with this wave. There's probably not a country in the world that has gone through a second wave that hasn't found it particularly challenging. It has very different and complex elements to it that make it quite difficult to manage.
Five minutes away from the opening bell in New York City, equity futures near the lows of the session, down 34 on the S&P, off by a little more than 1 full percentage point. Around about an hour ago, some disappointing jobs numbers. The GDP print is the one for the economic historians. The path forward will be leaning on jobless claims, and the direction of travel is not encouraging going into next week's payrolls report. Let's get you some morning calls, shall we? Look at some of the analyst recommendations on Wall Street this morning. First up, Canaccord upgrading Blue Apron to a buy, an $18 price target. The analyst expecting pandemic tailwinds to result in long-lasting revenue growth. That stock is up by a little more than 3%. Your second call from Deutsche Bank, raising its Avis budget price target to $34 a share. The analyst expecting the company to emerge from the pandemic with solid earnings and stronger free cash flow generation. That stock is off by around about 0.9%. And your final call, it comes from Citi, downgrading Our Brands to a sell with a $17 price target. The analyst expecting the pandemic to hurt margins and provide little help to its long-term earnings power. That stock is off by around about 4%. Coming up on the program, nearly $5 trillion in market cap reporting earnings after the closing bell. Jefferies analyst Brent Thill joins us with a preview and a review of what happened on Capitol Hill in the last 24 hours. Ahead of the opening bell this Thursday morning from New York, good morning. Here is the price action 4 minutes away, with equities down 35 points on the S&P, and Europe looking ugly on the DAX. We're off by 3.5% from New York. This is Bloomberg.